This is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
Central bankers don't shout mission accomplished.
They are very deliberative right now in terms of not getting too far ahead of themselves until the data comes to them.
The data is probably more important than the dots in this case.
This is still a Fed that is looking to cut rates, very supportive to financial markets. So I think this is a pretty good setup here for bonds and stocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I'm definitely not alone when I woke up this morning and thought this. I cannot believe it's only Thursday. How was it not like Friday afternoon, market close, 4:01, wrap it up and get to the weekend?
Let's just say that it was Friday afternoon after 8:30 a.m. Eastern yesterday, because that pretty much closed the books for a lot of people, even though Powell tried to walk it back a bit.
Head to the beach and start the summer already, for goodness sake. Live from New York City this morning. Good morning, good morning. Equity futures just about positive on the S&P 500. 3 consecutive days of all-time highs on the S&P 500. CPI, the main event yesterday at 8:30 Eastern time, coming in cooler than expected. And then we all walked away from the Federal Reserve kind of dazed and confused about the projections.
It seems as though they were burned by experience, sort of conditioned by recent events. And that's essentially what the Fed seems to be signaling. They're happy with the progress, but they're not willing to declare victory. They're concerned that maybe the first quarter was something other than just a blip, and they'd like a little bit more. The market took that and said, we don't buy it. We're going with CPI.
I've got a number of takeaways from that news conference. I think one for me, and we'll talk about this a little bit later, was on the labour market with Chairman Powell. We're trying to work out whether payrolls of 272,000 on Friday overstates the strength of the economy. He basically said it kind of does, that maybe that number on Friday overstates where things are.
He didn't even try to explain it. Let's just put it that way. He came out and then someone asks, can you explain this? And he basically said, no, I cannot. It does seem like it is overstating things. And he used those words specifically at a time where he talked about how there's something off about the household survey and then what you get more broadly. That said, he didn't say it's wrong. He didn't try to cast any conspiracy theories that maybe some of the rest of us will, and just said, it's noisy. So we have to take it as it is and then move forward. Nonetheless, this is a Fed that a lot of people still think is firmly, potentially on the table in September, even if July is out of the picture.
At 8:29 yesterday, if I'd said to you that median dot would imply 1 cut for 24 and not 3, I think you would have said that was super, super hawkish. He really muddied the waters around that. We all had one question going into the news conference. Did they have this data before they gave those forecasts? And if they gave those forecasts and then got the data, did they have the opportunity to update the forecast? He said they had the opportunity to update them, but some people didn't take that opportunity to revise them. Now, does that mean that basically their outlook hasn't changed even with the print at 8:30? Or does that mean that the forecasts they put out are now a little bit dated? Which one is it?
Some, most. I mean, honestly, first of all, the answer is he is highlighting how confused and kind of split apart this Federal Reserve Committee really is. To your point, some people did revise it. Most, I think he said, did not. So the question of what their motivation was, unclear. It also really is highlighted by the breakdown of the vote. I think we should go over that again. Because to me, it really highlights just how bifurcated this FOMC really is. 4 Fed officials see no rate cuts this year, according to the projections. That is shockingly hawkish based on what a lot of people are saying. It's very much in the Torsten Slot camp. That is up from 2 officials in the March projections. 7 see 1 cut. So that would be leaving us in the 1 cut category. But 8 see 2 cuts. So it's not as if this is a Federal Reserve committee that's not going to go at all if they do see some serious weakening. What does that leave you? With confusion. And basically the likes of Bob Michael saying, I'm in charge now, and I will dictate where yields should go based on supply and demand dynamics.
It's really, really finely balanced. I think just to try and make it somewhat simple, the former Fed Vice Chair, Richard Clarida, was on with the team a little bit earlier on Bloomberg TV. He said on net, the Fed was hawkish. On net, on the day, it was a dovish day for markets. And I think that's the takeaway for markets. We closed at all-time highs in yesterday's session.
Just going off of CPI, you saw inflation come in at some of the lowest reads going back to 2021. This is material progress. And the market is taking that, and they're hearing the Fed's mess over here, and they're saying, OK, that's nice, but we'll look at CPI first.
Just want to flag some news for you just quickly before we move on. The G7 agreeing how to tap frozen Russian assets to get $50 billion for Ukraine. Anne-Marie with some great breaking news, some details around that. We'll catch up with AMH in about 26 minutes' time. I was reminded of that because of people on vacation on the beach, having a good time.
And you think she is?
I thought of Anne-Marie.
Yeah.
Immediately.
Well, honestly, for all those who are feeling bad for her, that we're basically, trolling her, she is trolling us so hard, sending us beautiful pictures, posting these magnificent vistas of beaches and saying, it's tough. It's tough life.
Eh?
So
small violins and all of that.
Yeah, very.
OK, let's get to the scores. Equity futures on the S&P 500 shaping up as follows. On the S&P, record highs at a close once again yesterday, positive by 0.07% this morning. Yields a little bit lower, down a basis point, 430.43 on a 10-year, and the euro going nowhere, just about holding on to 108 at 108.03. Coming up, John Stoltzfus of Oppenheimer as US stocks notch another record high. Former Kansas City Fed President Thomas Hoenig on a less restrictive Fed, and Collin Martin of Charles Schwab saying the peak in yields is behind us. We begin with our top story, the S&P 500 topping 5,400 for the first time in history, even as Fed officials predict just one rate cut before the end of the year. John Stoltzfus of Oppenheimer saying this: resilience is what's likely underpinning the economy's trajectory towards normalization. We believe the US economy is likely mid-cycle rather than late cycle, as some suggest. John is with us for more. John, good morning, sir.
Good morning, John.
Another all-time high in the equity market. And I just want to frame your views coming into 24 because I think it's important to sing your praises because you are a modest man and won't do it yourself. You came into this year and you said, I'm constructive risk, I'm long the equity market, but it's not dependent on this Federal Reserve cutting interest rates. I don't think they will anytime soon. What did you see that was like your guiding light around the story so far this year?
I think what it really was when we look back at it, John, is the thought that Jerome Powell does not want to be remembered for blowing it on inflation and letting inflation come back in after cutting. And I think the Fed mostly feels that way when you hear the differences in the Fed speak. The mix were some not expecting any cuts, others expecting 1, 2, whatever it be. Those of us who lived through the 70s inflation never forgot it. And the failure of Arthur Burns and what necessitated draconian measures by Paul Volcker. And then a 15-year period, as I recall, of Alan Greenspan and a science project learning what the modern Fed would be like in terms of where rates would go. I think that memory is very much in Jerome Powell's mind.
Calling what the Fed will do is tough. Yep. Calling how the market will respond to it is sometimes even harder. You got step one right. You got step two right as well. Let's talk about step two. Why did you believe that wouldn't be negative for equity markets? Well,
I very much remember when the 10-year was at around 9%, and I remember a Fed funds rate that was significantly higher, and I remember equities moving up. It was after I came into the market in 1983, so that was Volcker's second term. And I might have made a mistake. It may have been that the Fed funds rate was 9%. I don't quite recall. It's published in our pieces every week, but I can't remember everything. But what I will say is it depends if business can still grow revenues, if they can still grow earnings, and if there's enough innovation around, things are changing for the positive. Business people will move on that, and the market will get a sense as a discount mechanism that stocks can move higher. I remember speaking with clients when they were enamored by 12% coupons on fixed income, and I was pitching equities. Okay, for diversification purposes, we could have a little bit of both. But the equities were just screaming out that they were undervalued relative to where we were headed.
Are they still screaming that out? I mean, we're pretty close to your year-end target.
I don't think they're quite screaming it out. I think equities are closer near term to being fully valued. But I think that our 5,500 target is likely to be exceeded probably in the next few days if we don't get some catalyst for the bears to move in and take us down 5 or 6% as they've done so frequently this year.
Some people have argued that this is a fragile rally. This is the 28th record high as of yesterday. We're still counting. But it wasn't led by small caps. It wasn't led by sort of a broadening out at all. It was led by big tech. In particular, it was led by NVIDIA, by Apple, which became the most valuable U.S. company out there, surpassing Microsoft once more. So do you view this as potentially a negative sign, that equal weight just keeps underperforming, even though the tailwind, ostensibly, was the potential for rate cuts?
Well, I've got to say, the thing about the big tech companies is that they're profitable. They've got positive cash flow, and they're deeply embedded in our lives. Oppenheimer doesn't allow me to talk about individual companies because I manage money, but I can say, well, I can say
AI chips.
AI chips are essential to where we're headed, and businesses are looking to invest in AI because they want to remain competitive, they want to be more efficient, and they want to be able to navigate tougher environments. If anything, today, people over the last 15, 16 years have been some of the toughest times. You know, the great financial crisis, the pandemic, the whole mess with the global supply chain, a move towards diversifying away from one country's centricity, dependency on the global supply chain, all this stuff. And it requires advanced logistics, all kinds of technology to navigate this. So, you know, the other side of it is, but I can say there is one company that we all know very well. If we brought out our cell phones, probably all the cell phones would be by that company. What did they do? They set it up so if you want the latest in AI, you have, if you don't have the phone that came out this year,
buy a new one.
Phone, you got to. We're all tied to an upgrade cycle, whether we like it or not, irregardless of who's supplying our technology. And that makes tech very important, and not in an artificial sense, because it's both business and the consumer find it deeply embedded in their lives.
So you're bullish, Jensen, and bullish, Tim. I'll say that for you. You're overall constructive on this equity market. Now, I understand why. It's fairly convincing. We had an upside surprise on payrolls. We had a downside surprise on CPI, and a Fed willing to cut interest rates at a first sign of weakness. Sounds pretty constructive. My favourite question for you, what would change your mind? What would you need to see that would lead you to come on this programme and say, John, change my mind, don't see it the same way, trim some risk?
It's what Barton Biggs would have called the bolt from the blue, the sock to the jaw, you know, the unexpected problem that emerges that would cause people, like in 22, when everybody just projected negatively overnight, not us, but it could sour sentiment near term or something really dramatically awful. But otherwise, where we're headed just looks like there are more positives to offset the challenges and the negatives that appear.
Yeah, well, we're not even halfway through the year, and we're, you know, basically a stone's throw from your year-end target. Yep. So barring some sort of cataclysmic event, how close are you to upgrading your year-end target? Oh,
I would say very close, but it's our discipline happens to be that unless the S&P closes at or above our target, we don't raise it because we don't want to jerk the clients around. You know, there's a lot of people will just, they'll upgrade and downgrade and they'll give two different targets and everything. We're pretty disciplined on our targets and fortunate that we've been fairly successful with them over the years.
You stay disciplined, John. It's great to see you. And you've had a fantastic year so far, and you've been working very hard. We appreciate it.
Knocking on whatever this substance is.
I believe there's a little bit of wood in there, buddy.
So knocking on wood.
Hopefully there is. Okay. John Stoltzfus of Oppenheimer. John, thank you. The equity market closing yesterday north of 5,400, 54.21, an all-time high on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. G7 leaders have agreed on a plan to tap frozen Russian assets to provide Ukraine with $50 billion of fresh aid. That, according to people familiar. After months of discussion, the plan is set to win the backing of leaders who are currently at the summit in Italy this week. The structure of the loans would reportedly be based on the size of each of the individual economies. The nations would then give loans to Ukraine, and they would be repaid using the profits generated by the some $280 billion of blocked funds, most of which are immobilized in Europe. Let's get you a check on Broadcom this morning, surging 12% in the pre-market. They had quarterly results and forecasts that topped estimates, thanks to robust demand for AI products. Given that Broadcom makes components vital to data centers, they also announced a 10-for-1 stock split. Shares of Tesla, they're also up in the pre-market, just above 5%. CEO Elon Musk says that two key proposals to ratify, one, his pay package, and two, move their legal home from Texas to Delaware, are going to pass by a wide margin. Tesla's shareholder meeting is today at the company's headquarters in Austin. And that's your brief, John.
Hey, Danny. Thank you. More from Danny in about 30 minutes' time. Up next on the program, the Fed leaving its options open.
We think policy is restrictive. And we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy.
That conversation just around the corner, live from New York City this morning. Good morning. Live from New York City, all the fireworks, the fun, the games, all yesterday at 8:30 Eastern Time. CPI cooler than expected, sending equities to an all-time high on the S&P 500 right now, adding just a little bit of weight to that by 0.04%. In the bond market, yields just about unchanged at 430.82. Under surveillance this morning, the Fed leaving its options open.
We think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, you know, since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting.
So here's the latest. The Fed penciling in a 1 rate cut this year from the previously expected 3. However, Powell keeping the door open for more as investors still bet on 2 in 2024. Have you got all that? For some clarity, Thomas Hoenig now joins us, the former Kansas City Fed president, known widely from Fed watchers as Mr. Dissent himself. Fantastic to catch up with you, sir. Thomas, I want your opinion on just how divided you think this committee actually is.
Well, I think it's divided. I don't know how much. It appears that it's pretty widely divided, perhaps. And I think that's because I've noticed inside, at least in their speeches and so forth, these members are talking more and more about their so-called long-run natural rate or the equilibrium rate and what that might be and how that might influence things. And I think there's a disagreement there. I think some, myself, if I were there, I would be included in this, think that the natural rate or the real equilibrium rate long-term has moved up substantially, closer to 2%. And if that's the case with 5% inflation with 5% Fed funds rate and 3% inflation, you're about 2% real Fed funds rate equal to the long-term equilibrium rate, or R star, and therefore you're in a steady state. So you have a period where you're going to maintain a 3% inflation rate over time. And then there are others who think, no, that rate is still very low and therefore we're restrictive. And I think that is still carrying the day, and I think the chairman must believe that as well. And so they're going to wait and see. But it's not terribly restrictive. Even the chairman knows that. And so it's a long-term kind of expectation that inflation will come down gradually over the next year or so.
There are a range of beliefs on the FOMC, and we can see that in the scattered dot plot. I'll share some of the details, Thomas, with our audience. Lisa did this a little bit earlier this morning. You've got the median dot signalling just 1 cut for 2024, but you go through the individuals in the dot plot. 4 policymakers saw no cuts this year, 7 looking for 1, 8 looking for 2. You were part of the evolution of the post-GFC communication apparatus at the Federal Reserve. Do you think it's had its day? Is this more harmful than it is helpful?
No, I don't think it's harmful. I mean, the fact that they are having this internal discussion and this uncertainty, I think the market should know about. You give them this very strong, confident, we know this is where it's going, and you mislead. So it is a very tenuous period. No one knows for sure. And this kind of reflects that. And I don't think that's necessarily bad. And it also means that they're probably not as coherent in their no change as some people would like it to be. But one thing is sure, the one thing they are agreeing, and you know it, is there are not going to be any rate increases barring a upside surprise. A huge increase in productivity, which is unlikely, a shock of inflation, which is at least unlikely. But on the downside, it's just a matter of when. Are we going to be there sooner or later? And okay, I know that, but I know which side the bias is on. They're going to ease eventually.
Thomas, it's when they begin the rate cutting cycle. It's not just when they make a cut. And this is what I thought was really interesting yesterday. It showed the same rate cutting cycle kind of telegraphed by the Federal Reserve, just pushed out maybe a quarter, just pushed out by a couple of months. Do you think that that is an error? That basically this is an economy, based on what you just said, where the Fed funds rate isn't that restrictive, and we can kind of continue here for a longer period of time, and maybe they're not going to hike rates, but in your view, maybe they shouldn't cut rates either.
Well, in my view, they are at a steady state, so they at least should not be cutting rates anytime soon, because right now we're at 3%. And if you look at it, we should stay in that range for some period of time based on my estimate of the long-run equilibrium rate at 2%. And I think that is, that's on the margin. I mean, that means we're going to stay at 3% for a long period of time. And a lot of people in the market and elsewhere are very happy with that. And they would be fine with that going forward. I think that is the issue, because, what would cause them to ease sooner is a banking problem, some kind of a negative shock, which is more likely than a positive shock. But in the meantime, they should at least be staying where they are and not projecting that we're going to lower rates another time this year. I think it's unlikely that they will, barring a shock.
You helped run the FDIC for many years, and you just talked about the potential for some sort of banking crisis or a banking shock. Mark Zandi of Moody's came on this week and said basically that's his big concern, that you are seeing cracks under the surface, particularly with smaller and regional banks, where some of them are not going to survive. Do you agree? Do you think that that is a real risk, or do you think that that is overstated and just simply a number of firms that have a bunch of loans on their books that are underwater, they're going to have to work it out, but it's not systemic?
Well, I think the banking industry is more vulnerable than the Fed would like you to believe. And I understand. I mean, if I were the chairman, I'd be saying things are fine because you don't want to precipitate a problem in the banking industry. But when you look at the numbers of the industry, given the very significant increase in interest rates last year, they are struggling. Number one, you have very large hold to maturity unrealized losses in that book. And the idea there is that over time that'll turn over and they'll get through that, take an earnings reduction, but they'll get through that. But on the other hand, on their loan portfolios, not just their commercial real estate, but some of their commercial industrial loans, those are also under very significant pressure given the rise in interest rates and all the repricing that has to go in the economy. So that makes the industry more vulnerable. And that means I think it would be very difficult for the Fed to increase interest rates right now, because it would worsen that situation and perhaps bring it to the surface. And I'm sure they feel they need to avoid that. And that's why they won't be raising interest rates anytime soon, because of that vulnerability, in part at least.
Thomas, this was a privilege. It's fantastic to catch up with you, sir, and hopefully we can do it again soon. Thomas Hoenig there, the former Kansas City Fed president, joining us live from Washington, D.C. on the Federal Reserve decision. If you're not familiar with dissent at the FOMC, that's because it's incredibly rare. For this man, it really wasn't at all. It was no, no, no to more QE. And I think there was a string of no's after that coming out of the financial crisis.
Very concerned about too big to fail. Very concerned about what kind of precedent you were setting in terms of incentivizing people to do bad things and then get bailed out afterwards. Question is, are we still seeing dissent on the FOMC? It's just is kind of masked under this veneer of sort of collective thought. Because frankly, we keep going over that split. That is not exactly, all come together and sing kumbaya type of FOMC.
So you can remind me of this, OK? You can remind me of this, I promise you. No problem. I'm looking forward to the Fed speak, OK? Just am.
Good.
Just a couple of days of it. 2 weeks in, then you can start saying to me, John, you said you were looking forward to it, but a couple of days of it. I'm looking forward to it.
You get some today. At noon, you have John Williams, the New York Fed president, who's going to be interviewing Treasury Secretary Janet Yellen at the New York Economic Club. My guess is there won't be that much directly tied to monetary policy, but watch this space, because talk about the confluence of fiscal policy with monetary policy, and two people very much in position to talk about that.
Well, if there's some Q&A, I know what I would ask. I'd want to know, did you upgrade your forecast after you got the CPI print, and if you didn't, why didn't you?
Yeah.
I've got some questions about that. I think we all have. Coming up, we've got some questions for Anne-Marie, some fantastic reporting out of Italy, AMH of the G7 in just a moment. From New York, this is Bloomberg. Quite a session yesterday. Quite a session. I don't think we're going to top that today, that's for sure. Equity futures on the S&P 500, muted moves, up by 0.07%. On the Nasdaq 100, up by 0.6%. What are you laughing at?
Are you daring someone to say, hold my beer?
No.
We're not going to up this again.
Okay.
We're not going to have a 29th record high. Good luck.
Give me the camera back. Let me start again. All right. Just to clarify, based on the schedule, I don't think you're going to have a session like that. again.
Okay, fair point. Fair
There's
point.
no CPI 8:30. We got jobless claims. There's no Fed decision this afternoon. I'm not trying to tempt anything.
Good.
All right.
I know, but that was good. That was
Clean
good.
that up. It's too early for this. Switch out the board and get to the bond market. 2-year, 10-year, 30-year. Looks like this. 2-year yields unchanged. 4.7516 on a 10-year. 4.3082. Some wild swings following CPI yesterday. And then if you just had a look at a chart of, let's say, the 2-year, we had this big move lower on a 2-year yield at 8.30, and then Lisa just unwound a lot of that as the session progressed. The Fed decision came out. We got the projections a bit more hawkish than expected. And then after that, Chairman Powell starts talking, and we want to know, like, OK, did you see CPI and did you put that in the forecast? And he basically said, yes, some of us did, but most of us didn't, and yields went up a little bit more.
Basically, it didn't have the same kind of dovish tilt that a lot of people were expecting, especially after the victorious-seeming CPI print that came in at the lowest going back to August of 2021. The issue is, it couldn't really, his sort of reticence to embrace it couldn't outdo what we saw for CPI because it frankly was confusing. There was a sort of hawkish tilt maybe under the hood, perhaps, depending on different members, but there wasn't a lot of conviction. We all walked away feeling like the Fed was confused and ready to respond to any kind of weakening in the labor market.
I'm not sure they're confused, but I certainly was. After some of those explanations, I want to turn to the euro. 108.52 was a session high yesterday. We had a lot of euro strength and much more so dollar weakness in yesterday's session. We unwound a lot of that as well, actually closed the session out at about 108.09, and that's basically where we are at the moment at 108.08. That currency pair is totally unchanged. Under surveillance this morning, want to get you some top stories. Here's one for you. Manhattan rents slipping for the month of May. According to data by Miller Samuel and Douglas Elliman Real Estate, rents were down 3.3% year over year. The median rent coming in at $42.50 per month. New leases were up 41% from a year earlier, but inventory also climbing about 28%. So volume's up, inventory's up, and things are starting to stabilise just a little bit.
And basically what you have from Jonathan Miller over at Miller Samuel is that this isn't the beginning of some sort of trough or bottoming out or some sort of massive decline. It's just sort of a market that's moving sideways after a lot of price appreciation. The volume aspect is interesting. This highlights all the people who are living in their apartments, renting because they can't buy, who get slapped with some sort of increase in their rent prices and say, no thanks, and they look elsewhere. This is basically that pushback, and they're able to look elsewhere because of the leasing volumes, maybe because you finally have some of those empty apartments being unleashed into the market. Either way, this actually speaks to a more healthy market with an actual activity pipeline that we haven't seen in quite a while.
Clip this video, show it to your landlord. Rents aren't going up in Manhattan. I can't get excited about $42.50 though. Can you? It's so expensive. Isn't this part of the broader inflation conversation, though, that we can sit here and say prices are flat on Manhattan rents, and for most people, they're like, that's meaningless to me. They're $42.50.
That's the reason why a lot of people say it'll just take time, because this is such high values relative to where they were, say, 3 years ago, that it's still sticker shock. And that's going to be a perpetual problem politically and certainly for the Fed in terms of messaging.
Let's get you some politics and some messaging too. The former president, Donald Trump, has a busy day in Washington today. Trump will meet with Republican lawmakers on Capitol Hill this morning. Then Trump is set to meet with some Wall Street CEOs, including JP Morgan's Jamie Dimon, Citi's Jane Fraser, Bank of America's Brian Moynihan, and he's catching up with Apple's CEO, Tim Cook. This all according to people familiar with the event hosted by the Business Roundtable. That's going to be an interesting day ahead for the former president and for those individuals.
How much things have changed from, say, 6 months ago. I mean, when you think about it, there was a time when a lot of these business leaders said they were never Trumpers. They were going to stay away from the election. They were not going to necessarily, they're not never Trumpers, but they weren't going to necessarily get involved in the election that seemed a little toxic to them. Now they will engage no matter what, even with the sort of verdict hanging over the former president and the whole concept of felony, et cetera. It doesn't really faze executives, considering the fact that he still very well could be president and they still want an in, given some of the policy shifts that are coming down the pike.
I think most of those individuals are incredibly pragmatic. And we often refer to Tim Cook as like the diplomat of technology, because he's managed to avoid a lot of these divisions between the United States and China. So for those individuals, I'm not surprised. For some others, for some people who have come out on the record have been like, could never work with the guy, I'd be more surprised with them. These individuals, I'm not so sure.
I'm curious what they want to know from him. I'm curious what the conversation is like, how much he basically is giving them a sense of what policy is going to be, or whether it's basically a meet and greet and get your face seen and basically say, we're on your side. We didn't actually, drag your name through the mud, so don't be mean to us.
Let's see. Look, I think Trump, at the end of the day, with people like this, incredibly impressionable. Don't you agree?
I would agree.
Yeah.
Especially given the fact that potentially they're donors. Let's watch that space. And two, potentially, if he's very sensitive to the equity market, Tim Cook accounts for a significant portion of the equity market. So, I mean, ostensibly, he might be somewhat deferential.
He's a Dow kind of guy, though, not an S&P kind of guy.
Says who? Is this breaking news?
Likes to quote the Dow a lot. He's a Dow kind of guy.
Is that true?
The former president's a Dow kind of guy.
Really?
He'd quote the Dow. Absolutely.
You think so?
Oh, yeah.
Okay, you heard it here first. So maybe we should index the Dow.
Strikes me as a Dow kind of guy.
What is a Dow kind of guy?
80s New York is a Dow kind of guy.
Okay.
Yeah, 80s New York.
So then why don't we have an index? So if he becomes president again, we should have the Dow being the benchmark index for most ETFs out there.
The real test is when you get an all-time high, what do you quote? And he would quote the Dow.
Okay.
No doubt about it, because the Dow connects with a lot of the electorate.
So you're going to have a lot of GE.
The S&P, it's like Wall Street.
Okay, so you're going to have a lot of GE, a lot of Caterpillar.
Yeah, something like that.
Yeah.
Sure.
Okay.
There you go. All right, let's get to this. Some real news. That's not actual news, obviously. OK, too much. Didn't sleep last night, you can tell. G7 leaders agreeing to a deal to provide $50 billion of new aid to Ukraine, according to Bloomberg's reporting. The agreement would hand out loans to Ukraine, which will be repaid by tapping about $280 billion in frozen Russian assets. Anne-Marie working hard to break that story for you. She joins us now from the G7 summit in Italy. AMH, what do we need to know?
Well, they've reached this deal, Jonathan, which they've worked on literally for months. The United States wanted to get this over the finish line. What they really wanted to do is that these assets, these frozen immobilized assets that are sitting in Europe, about $300 billion worth, are collecting interest on these securities. And instead of just giving the interest that are accruing year by year, they wanted to front load it. Basically, a loan, a line of liquidity to Ukraine, especially before critical elections. It's a way of election proofing some of the financing that they feel Ukraine needs. And they've been able to come to an agreement. Some technical work will still need to be done after the G7. But given the fact that they have this agreement, they want those funds to reach Ukraine by the end of the year. It'll be about approximately $50 billion worth, with a number of countries willing to sign up. Of course, the issue is that they need to make sure that at some point they get to be paid whole. So that is either through the payments on these interests in the future, or if there was some sort of peace negotiation at some point, if this were to end, then Russia would have to pay reparations for that money. So that's where the agreement is right now. And I would say that this was one of the biggest deliverables the U.S. wanted to get. They're going to have it, and they're going to be able to talk about it alongside Volodymyr Zelensky today when President Biden delivers a press conference with him.
The first point you made, I think, is the most important point. The fact that all of this now will be front-loaded, because as we know, the Europeans have already agreed to provide Ukraine the profits twice a year, anywhere between 3 and 5 billion. What they're doing now is front-loading it all to avoid what might happen in the future. Take a look at the picture at the G7. Anne-Marie, I think this is really instructive. You go through the individuals here. Macron, weak. The Biden presidency, hanging by a thread going into November. Sunak, I can't even describe how bad the polls are for Rishi Sunak in the UK. Scholz, certainly not Angela Merkel when it comes to the international stage. As for Trudeau, I'll save what I think of his prospects going forward from here. AMH, one by one, it screams weakness for the year ahead. How important was it to do this now, given what the next 12 months could hold?
This was basically the closing argument for many leaders, negotiators in the room. We have to do this now because the upcoming elections in these countries, and most importantly in the United States, if you're a European leader, you're sitting around this table and you think November's a coin toss, you have to sign up for this agreement now if you want to make sure that Ukraine has funds to draw on as they try to, one, fight Russia in this war. And also when it comes to reconstruction, these leaders, Jonathan, are walking into the luxury resort of Borgo Egnazia today, weakened and embattled at home, dealing with an electorate that pretty much has said that we don't always agree with you as leadership. Why it was so shocking this morning when Jake Sullivan briefed us reporters on the ground saying that Biden is entering this fourth G7, that with the G7 that is more aligned than ever. Maybe these world leaders around the table are aligned with their vision for the future, but not all of them are aligned with their electorate back home. And you named all of them except for one, Giorgia Meloni. This is a coronation, this G7, basically, they're coming down to Puglia to kiss the ring of a brand new European leader. And even the opposition party in Italy and even left-leaning civil servants that don't agree with her politics, they say, Ma è brava, but she's good. And that's where Europe is today.
Anne-Marie, can you give us a sense, based on that dynamic, how much are they kissing Meloni's ring and how much are they setting up a landscape to sort of surpass the wave of whoever gets voted in next? In other words, how much are they trying to sort of immunize the whole project that they've been working on of the international order of yore in order to go forward with things like Ukraine, with things like some of these steps against Russia, against China?
Well, they're trying to come to agreements on a number of these issues, but even within the G7, you can see there's large gaps when it comes to things like China. The United States is putting 100% tariff wall up when it comes to Chinese electric vehicles, which, by the way, there's not a single Chinese EV in the United States right now, while in Europe, they're taking a very nuanced approach. 17.4% say for one Chinese EV maker, as high as 45% for another. And this has a lot of concern with different members within the European Union and around the G7 table. Say Olaf Scholz. They begrudgingly are signing up for this. He was just at an Opel car manufacturer talking about the fact that we should not have trade restrictions. It makes everything more expensive, people more poor, and they're just going to reciprocate it on the other end for our foreign companies. So it's challenging, but that is why it is so important that they were able to, in their collective mind, get to this at least understanding when it came to the Russian assets, because they don't know what's going to happen in the future in a number in their countries. If you think the U.S. election is a coin toss, you think Rishi Sunak potentially is out of the job in exactly 3 weeks' time. Macron had to come out and say he's not resigning after he had to call snap elections because of the huge blow he was shown over the weekend for the European parliamentary elections. You can see that it's not so much that Meloni is moving towards them. I think they're trying to move into the direction of Giorgia Meloni, especially those who really doubted her when she came to power.
So what's left at this G7 summit now that we've had the Ukrainian announcement and basically we've understood that shift in power?
Well, the one thing is going to see some of the details potentially Biden's going to outline today when he stands alongside Zelensky when it comes to this bilateral security agreement they are talking about. We do know that the United States sent another Patriot missile system to Ukraine. Some of the details regarding that. This is another example of trying to election-proof a policy, have this security agreement in place before the U.S. election. Now, it's not a treaty, so a future president can pull out of it, but you can see some of these ideas on the margins have to do with this overreaching theme of trying to set up the rest of the year in case these leaders are out of power. I would also note something really interesting happening on the sidelines today, of course, is going to be this infrastructure summit. The United States has put up some $60 billion when it comes to global infrastructure around the world for middle and lower income countries. You have Larry Fink and Satya Nadella here alongside G7 partners talking about that critical infrastructure. What they're not going to say out loud, but I think is very obvious for anyone who follows these stories, at this is clearly their pitch to the global south and countries in Africa to do business with the West, and please do not do business with China.
MH, fantastic work. We'll touch base with you again in about 60 minutes' time. Anne-Marie on the ground in the south of Italy for the G7. Headed up by Giorgia Meloni. Equity futures on the S&P 500, just about positive on the S&P. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Apple isn't paying OpenAI to use its chatbot. Apple believes that promoting ChatGPT to its users is of equal or greater than monetary payments, according to people familiar. The iPhone maker revealed a partnership with OpenAI during its Worldwide Developers Conference this week and said that ChatGPT will be offered for free on Apple's products. Their deal isn't exclusive either with OpenAI, and the company is already discussing offering Google's Gemini chatbot as another option. The list of the wealthiest people in the world just got an update in a big way. Larry Ellison of Oracle saw his fortune jump $14 billion on Wednesday. His company had just reported enormous demand for its cloud infrastructure. It's Ellison's biggest one-day increase ever, and it makes him the world's 7th richest person. Oracle is expanding its cloud unit to compete with major players like Alphabet as demand surges for capacity to support AI. Netflix says that it will air a live hot dog eating competition on Labor Day. The main combatants will be Joey Chestnut taking on rival Takeru Kobayashi. The announcement comes a day after Chestnut was banned from the annual July 4th Nathan's famous hot dog eating contest in Coney Island. It's because he had signed a marketing deal with Impossible Foods, which makes plant-based food and a meatless hot dog. And that deal apparently broke certain hot dog exclusivity provisions. And that's your brief, John.
Hey, Danny, thank you. As Danny's telling us about that story, what did you say? This is very controversial at home.
Oh, yeah. Oh, yeah. There's basically like, is it even going to be a hot dog eating contest without Joey Chestnut? And Joey Chestnut's going to basically, what are we going to have like a, beyond meat kind of hot dog eating contest that Joey Chestnut's going to be like,
Shouldn't this be open to vegans?
Well, I mean, right.
Shouldn't exclude, right?
Exactly.
We want an inclusive hot dog eating contest, don't we?
Do you know they work out really hard? They need really good stomach muscles to really compact it in there.
They don't work out.
No, I'm serious. They do. Actually,
this
is point of big analysis.
Okay, you tell me more about this in a moment. Up next on the program, the market taking control.
This is a confused Fed. What that tells me is the bond market is in the hands of people like me. I want to be concentrated in the front end of the curve, and I like credit because everything's telling me we're gliding into a soft landing.
Bob Michael's in charge. We'll talk more about that next. From New York, this is Bloomberg. I take it back. Ripped.
Totally.
Absolutely
Kobayashi.
Shredded. Didn't realise.
Yeah.
Didn't know that was a thing.
10-pack.
Why'd you need that to eat hot dogs?
I don't know the mechanics of it.
Just
I'm not
wondering.
an expert in eating contests.
I'm just wondering, does he happen to be ripped and he also does the hot dog eating contest, or do you need to be ripped to do the other?
There was a time when I actually looked into this because I was very curious about the obsession, and it sort of increases the stamina, and to be able to sort of compress it in your stomach and keep going. I don't think we really need to be doing this because people are eating breakfast, so we'll leave it there.
Okay, let's leave that there. That's impressive. All right, kinda. Equities on the S&P 500 look like this, positive by 0.06%. The bond market pretty stable. Yield on a 10-year, 430.82. Under surveillance this morning, the market taking control.
This is a confused Fed. What that tells me is the bond market is in the hands of people like me. I don't know what the Fed's thinking. I don't know what they're looking at. I don't know what they're going to do. All I know is current levels. I want to be somewhere around neutral. I want to be concentrated in the front end of the curve. And I like credit because everything's telling me we're gliding into a soft landing.
So here's the latest. Treasury yields holding steady after a bond rally sparked by cooling inflation. Even as Fed Chair Jay Powell of the committee project just one rate cut this year, it is by a very, very slim margin. Collin Martin of Charles Schwab writing this. Yields are likely to stay elevated until the timing of the rate cuts seem more likely. There's room for the 10-year yield to drift higher, but we maintain that the peak is behind us. As long as the next move by the Fed is a cut, then the 10-year should stay below 5% and the yield curve should remain inverted. Collin joins us now for more. Collin, great to catch up with you, buddy, as always. I just want to jump into the comments from Bob Michael at JP Morgan. This is a line of questioning that Lisa's really been pushing over the last 24 hours. Who's in control here? Is it the Federal Reserve or is it investors, market participants like yourself?
Well, you could probably argue that market participants are always in control because they're the ones actually driving the investments out there and really dominating what's happening beyond that super short end of the curve that the Fed sets its policy rate at. If we go back to the comments from Bob, we did find the summary of economic projections and the expected path of the Fed funds rate. That was a bit confusing, but I don't necessarily think it's a confused Fed. We were confused, though, because if you look at the comprehensive look at the economy, it's still relatively strong. I mean, growth unchanged and slightly above trend, but then a modest uptick inflation. It begs the question, why even project rate cuts at all? But if you look into to Powell's response, I think there's a few things that we can focus on. One, he mentioned the idea of having conservative estimates. And I think this falls in the lap of both Fed officials and market participants and how we react to everything they say and do. But I think if you go back to last December, maybe it was a more benign outlook, and markets really latched onto that. So I think it could just be the Fed being a little bit more conservative about projecting how good the inflation outlook might be over the next few months. But he also mentioned base effects, and I think that's important. If you look at the current core PCE at 2.8%, and then see them projecting that same 2.8% by year end, looks like there's no progress there. But he did point out to the base effect idea. So I think that it was a bit confusing, but I think the theme is still patience. And the Fed just wants to see more data to make sure that inflation is convincingly moving lower, as opposed to just that one really good report we saw yesterday.
You said the bond market is usually in control. It's not actually the Fed. It's the way that bond traders sort of determine rates. That said, I remember the era of don't fight the Fed. That was sort of the mantra that everybody said. And once the Fed would come out, boom, all of the people who were trying to be contrarians would just get blown out of the water. Are we in a new regime where basically the Fed doesn't want to fight markets, not the markets not wanting to fight the Fed?
You know, I don't know about that. I think we do want to look at it from both sides. The Fed knows that they're looking at slightly different things. I mean, when we look at the outlook for inflation and how restrictive policy is, we tend to look at financial conditions from a financial lens. And if you look at it through that lens, financial conditions are still very, very easy. You see credit spreads low, you see stocks continuing to make all-time highs. Things look really good there. The Fed looks at it a little bit differently. So they're not paying as much attention, I think, to what corporate bond yields are doing, treasury yields are doing, equities are doing. They're looking at what's that level of restriction and how's that trickling through to maybe all the people that don't hold as many assets and maybe aren't benefiting so much from that wealth effect.
Jeff Rosenberg yesterday came on of BlackRock after the decision and said, this is a great decision for risk assets. Basically, you are looking at something that supports all valuations going forward, because on the margins, this still is a Fed that could cut rates in September and is very cognizant of the labor market. Would you agree? Was this sort of a boost of confidence that the reaction function was validating bets in riskier assets?
I would say it is. You know, we're still not super positive on all risk assets, especially with the bond market, but we're okay with taking risk. We're not suggesting anyone get out of the riskier parts of the market. Investors can still consider junk bonds, bank loans, preferred securities, you name it. It's really valuations that prevent us from being more optimistic. But I think it is a good thing. The fact that the Fed isn't really projecting rate hikes still, I think that's important. If we were to see the Fed being concerned that inflation is not just sticky, but maybe increasing, resulting in more Fed rate hikes, that would be a negative. We didn't see that. And if we look at, again, the comprehensive look at those economic projections, it's still a strong economy. So we're okay taking some risk. One of our preferred ways to take risk is high quality investment grade credit. We think it's a good balance of risk and reward there. Bob Michel mentioned that in those comments earlier, and we're sticking with that outlook.
Collin, there are some people happy in cash. They're getting 5%, and they've been told repeatedly on programmes like this that they won't get it for much longer. Then they keep getting 5%, and the Fed keeps pushing back rate cuts. Have you managed to convince those people to deploy that capital?
Baby steps, John. And I wonder how long I'll be on this program before you have to keep asking me that question. Our outlook has not changed, but we look at it again from more of a long-term view. Cash is very attractive. We can't deny that. We always say gradually extend duration because we know a lot of individual investors just haven't really done that. They're sitting in cash because of those high yields, and we'd rather not really be at the mercy of the Fed and lock in some yields with certainty. But one thing that we are highlighting is it's not just the treasury market that you need to look at. I know that's a huge concern for investors. Why the heck would I invest in a 10-year treasury at 4.3% when I can get 100 basis points more with a money market fund and a treasury bill? But if you look beyond treasuries, but still with high quality investments like investment grade corporates that I mentioned before, you can get just as high or even higher yields than what's available in treasury bills or money market funds and still kind of locking it in with certainty. So we're sticking with our call, but we're highlighting that you can look beyond treasuries.
Got it. You let me know if it changes. Collin, it's good to see you. Collin Martin there at Charles Schwab. Coming up next, Mona Mahajan of Edward Jones, Terry Haines of Pangaea Policy, Stephen Cook of the Council on Foreign Relations, and we'll catch up with Mike Collins of PGIM. The second hour of Bloomberg Surveillance up next.
We clearly are back on a path of progress.
Jay Powell is now holding all the chips. Look at inflation. It continues to come down. That glide path is intact.
At the end of the day, this is an economy that for the moment is still hanging in there.
It does matter when you start the cutting cycle. It really does matter.
I think absolutely September is in play.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It's Thursday. Just to remind everyone, if you're just tuning in, just still can't believe. From New York City this morning. Good morning on this Thursday morning. Equity futures are positive on the S&P by 0.1%. 3 consecutive days of all-time highs on the S&P 500. We add a little bit more weight to that. The Nasdaq 100 at an all-time high as well. Plenty of commentary following yesterday. This from Mike Gapon of Bank of America. Don't put the cart before the horse. I'm sure you get it. Chairman Powell saying we need to see more good data.
And that seems to be the theme right now, is sort of the Fed's in wait-and-see mode. The market's in, we'll take that as dovish. On the margins, not as maybe dovish as they had hoped for. But the bottom line is this. If the data is in control, people are taking the signal from the lowest inflation read, CPI read, going back to April of 2021, and that is giving people some real confidence.
It leaves the door open for a September rate cut, potentially. Even Team December acknowledging that in some of the commentary I read yesterday. Some of these forecasts, though, catch your eye. Here's one. Unemployment, year-end, 4%. Where is it now? 4%. Year-end next year, 4.2%. 2026, 4.1%. Introduce the commentary of Neil Dutta over at Renmac. The Fed thinks unemployment is going to be flat for the rest of the year. Good luck with that. How much luck do you think they need?
Well, he said, let's get on with it. There are a couple people who think that this is an economy that's tipping, and you're starting to see the labor market just turn on the margins, which is the reason why in about 90 minutes time, it will be interesting to watch the jobless claims. They still are relevant to understand whether we really are on that threshold of a turning point where we actually start to see weakening. We just haven't seen it yet. And this is a Federal Reserve conditioned by their failures, conditioned by what happened in the first quarter of this year, which is much harder than expected inflation. And they don't want to be on the wrong side of history, and you could feel that in some of the commentary.
Conditioned by the failures, not just of Q1, but of the 1970s as well. That's the market in the Federal Reserve. Plenty more on that. We need to track the politics down in the south of Italy. So the president landed in Brindisi yesterday evening, travelled a little north to Fasano, to a beautiful resort. If you ever want to go, I'm not going to name it because they can do their own marketing, but a beautiful resort just on the Adriatic coast. And this is what we understand so far, based on the reporting from Anne-Marie and the team, that the G7 have agreed on how to tap those frozen ration assets.
Without undermining the precedent of basically having some sort of safe haven in terms of where you park your assets. Essentially, it's a $50 billion loan that is backed by forward interest payments on the Russian assets. Got that? And basically, this is a way of saying we're not actually using your money, but we are using the interest that you might earn off that money for a forward projection. It supposedly is about $2 or $3 billion a year that it earns in interest. All this does to me is to your point, and I think you did this brilliantly, which is essentially say these are politicians that are insecure and want to lock in future financing for Ukraine at a time where there's a lot of dissent at home.
Their future's fragile. I think Anne-Marie used the phrase to election-proof some of these ideas. Just go through the list of people we're talking about. Trudeau in the polls in Canada. Tough time, right? Rishi Sunak. Is Rishi Sunak going to be the Prime Minister a month from now? Based on the polls, highly unlikely. The President of the United States, and that's the key one, Joe Biden, going into November, all through the swing states polls that we've looked at, he's behind. He could turn that around, we'll see, but ultimately he's behind. And we don't know what comes next and what kind of policies come next over the next couple of years. Macron has got his own mess at home. Some people might say that's caused by himself, but he can't run again in 2027. So you go a few years out, that G7 picture looks very, very different. A lot of those people in that picture may not be there.
And there's a great degree of uncertainty of what a Giorgia Meloni sort of run G7 looks like going forward if there's a different composition on the ground. What does that mean for Chinese competition? What does that mean for immigration? What does that mean for backing for some of the international efforts, including rebuilding of Ukraine? I wonder what else they're going to try to election-proof, or is this sort of the big jewel that they can kind of crown, given that they've been working on it for many months?
We'll catch up with AMH in about 25 minutes' time. Don't miss that conversation. Equity futures on the S&P 500. Your scores look like this. Positive by 0.1%. In the bond market, yields unchanged. Your 10-year, 431. The euro just a little bit softer. Some dollar strength creeping back in. 107.93 on euro dollar. Coming up this hour, we'll catch up with Mona Mahajan of Edward Jones with stocks at all-time highs. Terry Haines of Pangaea Policy as Trump meets with GOP lawmakers in Washington. And PGIM's Mike Collins on the line between 1 and 2 Fed rate cuts. That line is very fine. We begin with our top story. Stocks at all-time highs as cooling inflation data overshadows a hawkish Fed tilt. Mona Mahajan of Edward Jones writing this. We expect inflation to continue to trend lower in the months ahead, aided by easing labour market conditions and moderating economic activity, which could pave the way for 1 or 2 rate cuts later this year. Mona joins us now for more. Mona, wonderful to catch up with you. What do you think was more instructive yesterday? The data at 8:30, the Fed decision at 2 p.m, or the news conference that kicked off at 2:30?
You know, I'd put it in the order of the inflation reading probably first. I did think the updated set of economic projections that came out of the Fed was probably second. And of course, always interesting to get that tone from Jerome Powell himself. I'd say first and foremost, we do think that inflation print has probably now reset the clock. We are finally seeing this trend of disinflation return into the marketplace, and hopefully we see that in the months ahead. What was interesting to us about the updated set of projections, one, the Fed actually left that kind of 2026 Fed funds rate at 3.1%. So even if there was a shift in the pace to get there, it seems like their direction of travel is still towards a rate cutting cycle. And two, they kind of outlined a soft landing in the economy as well. We certainly saw GDP growth remaining around 2%. The unemployment rate around 4%, all the while inflation moderating. So an interesting set of projections, positive for markets overall.
Positive for small caps as well. The Russell had a bit of a day, had quite a day. It was up by 1.6%, the best day since the start of May. Was it anything more than having a day? Is there anything more to it than just that, Mona?
Yeah, it's a good point. You know, look, I think as we get closer to a potential Fed rate cutting cycle, this theme of this broadening of market leadership, we think gets more and more real as well. And so, of course, part of that broadening is the mid-cap part of the market and the small-cap part of the market. And from a sector perspective, we see not only the tech and growth sectors participating, we could start to see cyclical and defensive parts of the market play some catch-up as well. So I think part of that theme played out yesterday. As the Fed signaled rate cuts, we did start to see a bit of broadening, and certainly small caps played some catch up. I think part of that story is also if we get an environment where inflation does cool, the economy looks like, could rebound as we get better inflation prints and lower interest rates. In that kind of upswing in an economy, we do see cyclical parts of the market lead to the upside, and small caps are part of that.
Mona, we're all conditioned by the recent past. And when it comes to the broadening out, I find myself wondering, okay, is this it? Because we've been hearing this for quite a while. And even yesterday, even though we saw a pop in the Russell 2000, that wasn't the leadership. The leadership, guess what, was Apple, was NVIDIA, were the big tech names that have been leading all along. And actually, the equal-weighted S&P 500 significantly underperformed, only gained about 0.5%. Is it too soon to really bank on the idea of broadening out? Or do you think that it's kind of now to get in before you really see the whites in the eyes of the turn?
Yeah, we do think that there are 2 catalysts ahead of us for the broadening. One we mentioned, which is as we get closer to Fed rate cuts, we think that's one potential catalyst for this broadening. But the second is really an earnings story. And we need to see, in the back half of the year, the forecasts show that it is not just those 3 tech and growth sectors that are leading earnings growth. In fact, for Q3 and Q4, most of earnings growth is coming outside of the technology sectors. And so as that plays out, we do think that that's the second catalyst that will spark at least some meaningful broadening of leadership. Now, what we'd say more broadly in terms of the tech play, because it is a question that comes up quite often, these companies are not only leading the AI charge, which we think has long-term secular growth behind it, but they are also massive in terms of balance sheets. So, of course, in a higher rate environment, they're not tapping the debt markets. They certainly are returning value to shareholders through buybacks and dividends. And by the way, they're getting better returns on their cash as well. So they've almost become the play during the higher for longer environment.
It seems like you think we're either early cycle or mid-cycle. And that's somewhat different than what we've been hearing for the past number of months when people were saying, actually, we're late cycle. We need to see some sort of washout in order to get back to the inflation levels that we wanted. What's changed?
Yeah, I think generally we haven't yet seen the market turn, the economy turn in any meaningful way. Now, I think to your point earlier on the labor market, we're starting to see early signals that perhaps some cooling is in front of us. But we continue to see, rather than an outright washout of the labor market, perhaps a better supply and demand dynamic. And so If we do truly get this Goldilocks soft landing scenario, what could happen is you get more labor participation, more immigration that helps the supply side of the story. And in the meanwhile, the job openings and demand for that labor cools as well. But rather than the unemployment rate massively moving higher, you instead see wage gains starting to cool. And so that is a scenario that is right now embraced by the Fed, probably the base case adopted by the markets. But I think until we see otherwise in the data, it continues to play out nicely as well. And so I think that's essentially what's changed and why we haven't yet seen a real turnover in the economy.
Mona, let's just go through that again. Embraced by the Fed, somewhat adopted by the markets. And one of the issues that you pointed out was immigration, which is highly dependent on what could happen or may not happen in November. And I'm trying to work out, Mona, just how much we're flying blind into 25. We were sat around this table talking about the 2025 projections, and Mike McKee shot me an email, came back on TV and talked to us about it. Just said 2025. The outlook for 25 could change so much based on the turnout that we see in November. You get a blue wave, a red wave. You could see the Treasury market sink. You could see some big policies going forward from here. Mona, how much visibility do you have on next year?
Yeah, look, certainly the presidential election will play a key role in the direction of policy broadly. What we'd say is, of course, one, we're still envisioning a Congress that is pretty divided. And so we do think, regardless of who wins in November, checks and balances remain in place. And so any president will have difficulty pushing through major tax reform, major legislation or regulation without the support, fully of a Congress behind them. And so generally that gridlock environment we think remains in place. We know markets embrace gridlock because it gives them, to your point, a little bit more of a transparent operating environment. Also, we've seen historically in a 4-year presidential cycle, from a market perspective, year 3 tends to be the strongest, and perhaps we got that last year. But year 4, the year we're in now, tends to be the second best. And part of that is some of the uncertainty is lifted. Part of it, in theory, is that the administration is putting together a better environment for markets. But broadly speaking, it does feel like ahead of election day, you get some volatility, but in the 6 or 10 weeks after, we tend to see an upturn. And so that market volatility we get could be an opportunity, especially if we're in an environment where the president is a little bit less able to maneuver as aggressively as needed or as he wants.
I remember when we used to think, wow, the U.S. election's got to be a big risk. I wonder if it's keeping people away from U.S. assets. And then we learned, oh, wait a second, the risk is even just greater elsewhere in other nations. How much is the U.S. exceptionalism story ongoing? And how much does it really continue? Or are we seeing sort of a broadening out in that story, even amid all the political risks globally, not just in the U.S.?
Yeah, it's a great call out because I do think we are starting to see some participation and tick up in international markets, parts of EM, parts of EFA, non-developed U.S., starting to play some catch up as well. Of course, we are in perhaps what is a global rate cutting cycle. We've seen the Bank of Canada and the ECB move ahead of the Fed, 25 basis point rate cuts each. Keep in mind, though, those economies have softened more than the U.S. and their inflation stories have played more catch up as well. So better inflation dynamic, but softer economic growth in the economies that have started cutting rates. We'd say generally the U.S. exceptionalism story probably comes through most clearly in this AI boom that we're seeing. And of course, as we think about the years ahead, a lot of the enablers of AI, that Magnificent Seven cohort, the infrastructure, semiconductor players, all happen to be housed in the U.S. So from a market perspective, certainly seeing the benefits of that part of the economy really playing some true exceptionalism versus the rest of the globe. As we think about, the years ahead, if we start to see those productivity gains and efficiencies start to kind of spread throughout sectors that might benefit from AI, you think about financials, manufacturing and industrials, healthcare, those sectors are pretty prominent outside the U.S. as well. So perhaps we start here in the U.S. and we start to see some catch up in the rest of the world in the years ahead as well.
Mona, thank you. Mona Mahajan of Edward Jones breaking down this market in reaction to the data we got yesterday morning and the Federal Reserve decision later on in the afternoon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Another central bank decision on deck. The Bank of Japan is expected to consider reducing its bond purchases at this week's policy meeting. That reduction would mark the first clear step towards quantitative tightening after beginning to normalize policy back in March. Investors are also on alert for any signals on the prospects for an interest rate hike next month. Economists are projecting the BOJ will hold its benchmark rate between 0 and 0.1% when their two-day gathering wraps up on Friday. Donald Trump is back in Washington, D.C. today. The former president is meeting with leaders of some of the country's biggest companies. That includes Jamie Dimon, Jane Fraser, Brian Moynihan, and Tim Cook. That, according to people familiar with the event. During his one-day return to the Capitol, Trump is also set to meet with congressional Republicans. And European nat gas prices this morning jumping to the highest level of the year. There are fears of disruption over what's left of Russian fuel flow in Europe after a recent court decision. OMV, Austria's oil and gas giant, says that they are prepared to replace 100% of supply they might lose from Russia. I spoke with the company's CEO this morning on Bloomberg Brief.
We have been preparing for such events for the last 2 years. We have diversified our supply sources. We have booked pipeline capacity so that at any time we can ensure that we can deliver all our customers also with non-Russian gas in case such a interruption should happen.
Austria does still import more than 80% of their fuel from Russia. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the programme, Trump tightening his grip on the GOP.
This is just another, example of House Republicans bending the knee to Donald Trump. That's just how dysfunctional the House Republican conference is.
That conversation just around the corner. Live from New York, this is Bloomberg. Equity futures on the S&P 500 just about positive by 0.1%. In the bond market, yields unchanged. Your 10-year 431.60. Under surveillance this morning, a tale of two candidates. Here's the latest. Former President Donald Trump meeting with GOP leaders in Washington as he campaigns for a second term in office. Later in the day, he'll attend a business roundtable meeting with key leaders including Jamie Dimon, Jane Fraser and Tim Cook. At the very same time Trump is speaking in Washington, President Biden will be speaking at the G7 in Italy. Terry Haines of Pangaea Policy joins us now for more. Terry, let's do this side by side, the preview. How different are those two addresses going to be?
Well, of course, they're pretty different because one's primarily about domestic policy and one's about foreign policy. I mean, Biden will be doing what he's doing with the G7, talking about Russian assets and how to deploy them to help Ukraine, as you and Lisa were talking about a few minutes ago. And what Trump's doing in Washington today, frankly, is fundamentally making a pitch to business leaders and trying to show unity with with congressional Republicans to show what a 2025 all Republican Washington might look like. Now, I think that's only about a 30% likelihood at most. The split Congress is a split Congress, and with a tiny Biden advantage is my call today. But even if Trump's president, markets should understand that what brought on the animal spirits in 2016 wasn't Trump being president. It was Congress going all Republican that allowed the 2017 tax cuts to happen. So, the Congress, frankly, here for what markets care about is more important than the president. And that's kind of what Trump's trying to show.
Terry, let's just sit on the business roundtable. We're not talking about any CEO. We're talking about the CEOs of the biggest financial institutions on Wall Street, the CEO of Apple. There has been a question more recently over the last few months, particularly on this program, about how business-friendly a second Trump presidency would actually be. How business-friendly do you think it will be?
They'll try to make it so, and I think it probably would be should it come to pass. Although, as I say, it's not my base case. With a Republican Congress, I think what you get is if you get an all-Republican Congress, just as in 2017, you see the Congress driving things like tax cuts and the policies that business cares most about. They were much more in the driver's seat than Trump was on that sort of thing. I do think that if you see a Trump presidency with a split Congress, though, you're going to see a lot more of what I've been calling recently Mount Trump. Where he pushes back against those who don't want to do whatever it is that he wants to do in the Congress. Now, that relates mostly to, I think, fiscal policy and domestic policy. Let's remember that in today's Washington, just as in 2025's Washington, you're going to have an awful lot of unity on foreign policy, all to the good, and you're going to have an awful lot of unity on fiscal policy that, frankly, makes markets feel squirrely because it's more fiscal spend, more debt and deficit.
There's a lot that you said there that I want to unpack, but Terry, this idea that we might hear what a second term of President Trump might look like, what are you listening for, especially when it comes to the business world at a time when a lot of people really don't have certainty around that?
Well, it's a pitch. He's here for a lot of reasons. And just as any politician, you're trying to not only show what you do think, but you're trying to show what kind of reality you'd like to create. He's in the business of showing a couple of things. One, that he's business friendly, and secondly, that he's going to be a kind of a rational actor on a lot of this stuff. And he was on tax cuts. And one of the things that he wants to do is remind people that they'll continue to be a business. He'll be a business-friendly presidency, that he wants them to, and they should want to support Republican candidates in Congress to create that all-Republican reality that allows them more business freedom, less taxes, less regulation, that sort of thing. And he also wants to show, frankly, that he's worthy of being supported financially and rhetorically and every other way, because the reality, again, is he doesn't have a united party, and he's not attracting independents. One way to do it is to show he's clearly differentiated on economics.
Terry, you said that there also seems to be some unanimity on foreign policy at a time where President Biden is at the G7 trying to sort of immunize international policy from elections, given some of the latest moves on Ukraine. How do you square that? What does the united front in the U.S. look like when it comes to foreign policy and what's likely to come down the pike, regardless of who takes office, but maybe with a greater emphasis with another President Trump?
Well, you're going to have a situation where in 2025, regardless of who the president is, where the vast majority in Congress, and I think the vast majority of the public too, supports current U.S. foreign policy, supports helping Ukraine, supports helping in the Middle East, helping Israel, and getting peace there, helping in the Indo-Pacific, all the rest. One of the things that took so long in getting that aid, though, frankly, is that Biden was not very good, very forceful, pushing very hard to actually get that. It said everything that Biden announced this emergency in November, and yet no one, Democrat or Republican, on the Hill really reacted to it, and it took almost 6 months to clear it up. I suspect what you're going to end up seeing is a lot more urgency down the line, and I think just as last time, Trump largely gets led by Republicans in Congress to create a foreign policy and an economic policy that continues along the same lines. You may see a little skepticism on the margins, but right now I don't think it's going to be that significant.
Hey, Terry. Good to catch up, sir. Terry Haines of Pangaea Policy down in Washington on the latest. Quite a scheduled side-by-side, but given how late either could be, I imagine it's not going to happen precisely at the same time.
Nonetheless, the focus on domestic versus international, very interesting. And Terry is saying that there's quite a bit of consensus and that they'll come together around pretty much the status quo and continuing it. Sort of flies in the face of a lot of the rhetoric that is highly nationalistic that we're hearing globally and that we're hearing here in the United States. So I wonder just how it plays to the electorate. I understand what actually might happen is different than how you play it, but that's what I'm actually curious to listen to.
No, I'm with you. I think you're on the right line of questioning. There is some daylight, some real daylight between what they're focusing on at the G7 today, tapping into Russian assets, and what national electorates are voting on at the moment, based on the outcomes of those votes.
Which is the reason why you really identified how weak all of those leaders are as they stand for the family photo at G7.
Coming up just around the corner, G7 nations agreeing to tap frozen Russian assets. Their conversation just around the corner. Some live reporting from Anne-Marie. 2 hours away from the opening bell. Equity futures on the S&P just about positive by 0.1% after closing at another all-time high in yesterday's session. Bramo's counting. What are we on?
28.
28 record highs on the S&P so far in 2024. On the Nasdaq at the moment, we're up by 0.6%. The Russell had a day. Is it anything more than a day? We're down by 0.4%. It's a question I've got. I know you've got it too.
Well, it was a day, but it wasn't that great even compared to the Magnificent Seven because they still were overshadowed. I was looking at this. If you take a look at the Russell 2000, it was up 1.6%. The Mag 7 was up 1.9%. And it was really just Apple and NVIDIA. I mean, people say we don't talk single names. Okay, you don't talk single names. How about the leader in chips? How about the leader in smartphones? I mean, it's basically, we're talking about the same thing.
Look, leader in smartphones and chips, high rates, doesn't matter. Low rates, doesn't matter. Does rates even matter when it comes to these names?
You know, this is what I was thinking. Why did they get a boost from the idea of inflation coming down? What logic is that? Because arguably you could say that their income would actually go down if rates came down, given that their cash piles are now generating 5.5% interest. So at a certain point, really?
Saw some big moves in the bond market yesterday. Let's get you up to speed. So yesterday, CPI drops, 8:30 Eastern time. Yields plummet. See a big plunge lower. Double-digit basis point move right across the curve, particularly on the 2-year. At one point, we were down about 16 basis points at the front end of the yield curve. We gave half of that up once the news conference and projections really started to filter out. We started to process that this Federal Reserve really wasn't in a rush to adjust after that CPI report.
Dovish Nirvana would have been 2 rate cuts baked in, down from 3 in terms of the statement of economic projections. They only had 1, although with an asterisk. It was a pretty messy kind of combination and mix of different Fed officials. And then you would have had Chair Powell sort of undo some of the hawkish tilt by coming out and saying, actually, we just didn't really incorporate the CPI data and that could change things. He did not. He indicated they had seen it. So this all leads kind of a mush. And then you have people like Wei Li actually came out of BlackRock and she said, you know, the Fed doesn't know anything more than we do. Don't listen to them.
And by the way, there's some reason to believe that maybe those jobs numbers on Friday were overstated.
Yeah, did you like that?
It's quite aligned in that news conference, I thought. Lots of people picked up on that.
Well, the reality is it was confusing to everyone. And he said that he couldn't reconcile it. And they've been very clear about the fact that sometimes they can't reconcile it and they can't create a narrative. But the fact that overstated was the way that he went indicates sort of a dovish lean.
So the euro got a bit of a bump yesterday, some strength. The dollar weaker off the back of all of that, particularly off the back of the move in the bond market. Today, the euro just a little weaker, retracing some of those steps. 107.88 on that currency pair. Under surveillance this morning, Fed officials dialing back their expectations for rate cuts. The median projection now calling for 1 cut this year, even as US CPI came in softer than expected. Another read on the US economy, 8:30 Eastern time. We get PPI and jobless claims. Jobless claims, the estimate in our survey, 225. The previous number, 229. Given his comments on the labour market on Friday, just plays into what I think a lot of people already believe, which is this Federal Reserve is willing to ignore what looks like strength. But on any sign of weakness in this labour market, they'll be willing to move and cut interest rates.
And, you know, on the margin, that was kind of emphasized yesterday because the disinflation was really sort of front and focus. And they indicated they'd be willing to cut rates, even with inflation projected to be even higher than they previously expected next year, in the face of labor weakness. And to me, this is really the key. They're still hoping for that soft landing. They still want to land it. And that, I think, is a reason why a lot of people are saying, OK, we're not late cycle anymore. Suddenly, maybe we're mid-cycle. We got some more legs in this rally.
Mike Collins of PGIM joining us later in the programme to weigh in on some of this. I want to talk about Tesla just briefly. Shares are rising in the pre-market, up by something like 5% a little bit earlier this morning. Where are we now? Up by 6.8. Elon Musk saying shareholders voted, quote, by wide margins in favour of reapproving his $56 billion pay package and moving the company's official headquarters to Texas. The preliminary results coming ahead of the company's annual meeting in Austin today.
This just crossing, reporting by the New York Times Deal Book saying that Vanguard and BlackRock both voted in favor of that $56 billion pay package. So he got some of the big behemoths lined up behind him. Curious to see what the sort of win is in terms of the share pop. Is this essentially that they're not going to get any pushback or that Elon Musk isn't going to threaten to leave? It's not going to cause more turmoil at the top. What was the consequence if he didn't give $56 billion?
I don't know. It would be a real question mark over whether he wanted to continue leading the company, though, wouldn't it?
I mean, he still has a lot of money tied up in this company. And honestly, that's quite a look if he says, OK, I got $47 billion. No way. I'm out. Peace. I mean, at a certain point, really, can you do that?
My question is, you have to take the character out of this. I understand he could be polarising, whether you like him or not. Let's just remove Elon Musk from the conversation. And let's just say you've got a CEO of Company X. Maybe not Company X, that doesn't work. Company Y. You know where I'm going with that, of course.
Yeah.
Company Y, all right? And you say to this CEO, these are your milestones, you hit them, this is what you get. and people sign up for it. They vote for it. And then further down the line, they get to vote on it again. Never really made sense to me.
I hear what you're saying, which is basically, again, precedent. And how do you sort of understand the precedent at a time when this is somebody who is highly polarizing, but it's not sort of a popularity game necessarily. And he is still the founder and, frankly, the face of Tesla in every which way. The key point to me is there is some pushback. There's a question of where his allegiance is. And the bigger question for Tesla going forward is less how much he gets paid and more where he wants to put his chips, literally and figuratively, when he's trying to move out into more of a technological focus.
Over at Company X.
Exactly.
Apparently. All right, let's move on. G7 nations agreeing on a structure to use profits generated from frozen Russian assets to provide $50 billion in fresh aid to Ukraine. Bloomberg's Anne-Marie is on the ground in the south of Italy at the G7 and helped break this story. AMH, share the details with us.
Well, Jonathan, they've been working on months to try to get this deal over the finish line, and they are set to sign off on this today when G7 leaders will be meeting. What they're going to do is tap the future interest of these immobilized frozen Russian assets, $280 billion worth, which mostly sit in Europe. Now, the Europeans had agreed. This has been fraught negotiations for months. The Europeans had agreed to do this on a year-by-year basis. What the United States has been wanting to do is take the accrued interest that they expect from these frozen assets and front-load it now to Ukraine to get Ukraine more money up front and also really election-proof this, meaning by the end of the year, Ukraine would get $50 billion in financing, loans from the countries that are willing to sign up. The issue, of course, is going to be some of the technical details they're going to work out after the G7, but the political will is there, and they plan to go ahead with this. Of course, the big question is how do they get paid back? So those countries in the future years will get paid back those interests on these frozen assets. But this is a huge win for Ukraine. You remember what Dmytro Kuleba said to you, Lisa, and myself at Davos. He talked about the fact that this was a critical goal for Ukraine for 2024, and that once the politicians signed off on it, the bankers and the lawyers, they'll find a way to make it happen.
And they're making it happen right now. Reportedly, Anne-Marie, great work as always. Anne-Marie Hoenig at the G7 meeting in Italy. With us around the table is Stephen Cook of the Council on Foreign Relations. Stephen, good morning to you. It's good to see you.
Good morning. Great to be here.
Let's just talk about the difference between what voters seem to be voting on right now and what leaders seem to be talking about at the G7. How big is that gap at the moment?
Well, it seems to be a very big gap. I mean, Americans in particular are concerned with the southern border and issues here in the United States, whereas once again, the G7 are proposing to shovel lots of money in the direction of Ukraine. There's a case to be made for this, especially since these are Russian assets, but that's not the way it necessarily is translated among the American people. So the president, people in Congress need to make this case, and they don't seem to be making it.
What's the consequence of the greatly weakened nature of a lot of the leaders in G7 as they talk about some of these foreign policy initiatives? Is there any historical analog that you can draw back on for guidance on how this is going to transpire and how it's going to shape policy?
Well, the weakness of the G7, the weakness of the West in general, has encouraged people like Vladimir Putin, the Iranian leadership, to press their advantages in different parts of the world. When the United States has demonstrated weakness, particularly in the Middle East, the Iranians, now partnered with the Russians, have pressed their advantage. The chaos that we're seeing in that part of the world, the attacks on Ukraine that are unrelenting but have been fallen off the radar screens, are things that are dangerous to the Western political order. And we have a bunch of weak leaders who have been unable to make the case to their people.
Donald Trump has argued that under him, none of this would have happened. And some people say, maybe that is a bit of a stretch. There still were tensions under his rule as well. But other people have had some criticisms of President Biden's approach. What's your take on how he's countered sort of the growing unity of some of these nations, Iran and Russia in particular?
Well, count me as one of those skeptical of President Trump's argument that none of this would have happened under his leadership. I do think that President Biden was dealt a weak hand, particularly on Ukraine, and has in general held Europe together on that, despite the tremendous opposition within the U.S. Congress on Ukraine. The Middle East is somewhat of a different story. He has wavered in his support for American allies, particularly Israel. I mean, there has been tremendous amount of bloodshed here. But the way in which the president has sort of tried to cut deals and navigate between different political pressures here in the United States has essentially weakened the American hand in the region. And that's not what not only the Israelis, but also the Saudis, the Emiratis, the Bahrainis, and other partners of the United States, they want to see a strong hand against the Iranian malevolence in the region, which, of course, this horrible war in the Gaza Strip is all about.
So your book, the title, I want to borrow the phrase, The End of Ambition. Can we talk about that a little bit more? Do we have this reluctant hegemon? Is it tempted by isolationism? What is it all about right now? What's taken us down this particular path?
Yeah, after a period of about 25 or 30 years in which the United States engaged in this very ambitious plan to transform the region, there is a sense within, especially the American foreign policy community, but I also think among the American public at large, that the United States should withdraw from the Middle East. The investment wasn't worth it. And what the book says is, actually, there is an investment to be made in the Middle East, but not to transform the region, but to laser focus on what is truly important to the United States in the region.
What is truly important to the United States in the region? Because there are some people sitting at home at the moment, many, you see it in polls, they just look at what's happening abroad, they look at the G7, they look at the things they're talking about, and they say, this world order does not work for me, I'm voting for something else. What should the focus be?
Yeah, well, I lay out in the book 6. I won't bore you with the 6, but a number of them should be familiar to people, including the free flow of energy resources out of the region. Everybody remembers the price spike of gasoline at the pump in 2021 and 2022. Middle East is very, very important for the free flow of energy resources. Continuing to help secure Israel is a very important thing to many Americans. Counterterrorism, especially in this moment of turbulent world politics, and of course, non-proliferation. These are all things that remain important for the United States and things that the United States should invest in. Not remaking a rocky society, not promoting democracy in countries where leaders are going to resist that and where we can't achieve those things. The 4 things I just mentioned are things that are actually achievable.
More pragmatic approaches rather than ideological ones, I think
Absolutely.
is one way of putting this. We were just speaking with Terry Haines of Pangaea Policy, and he was saying, actually, there is some unanimity when it comes to sitting Congress members in terms of maintaining some of these relationships and the U.S.'s international footprint. Is that true? Is that your take on it, too, given the fact that the rhetoric seems to be pretty much at odds with that?
Yeah, Washington is deeply, deeply polarized. And I think the war in Ukraine is something that has really exposed those rifts. I think by and large, people want to maintain those relationships, that the United States is a global power. But there are questions remain as to how long and how open-ended the United States support for Ukraine, which is not a NATO member, is going to be. From my own perspective, we should continue to support Ukraine because after Ukraine, the Russians will set their sights on actual NATO members. We really need to actually, to use a terrible cliche that people use in Washington, draw a line in the sand when it comes to Ukraine.
Are you convinced they will, that they'd go after NATO members? They'd test that line, they'd cross it?
You know, it's hard not to take Vladimir Putin at his word in these speeches that he has given in the past about essentially the recreation of the Russian Empire should be taken seriously. No one took, on the eve of the invasion of Ukraine, both in 2014 and in 2022, no one took it seriously. And yet he moved against Ukraine.
It's very true. Stephen, it's good to see you. Thank you, sir.
Thank
Stephen
you.
Cook there of the Council on Foreign Relations. So let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Boeing is set to face FAA scrutiny for the, quote, foreseeable future. That according to prepared testimony seen by Bloomberg. The agency is set to place more inspectors at Boeing's facilities and at supplier Spirit Aerosystems. Boeing will face a hearing today in Washington after multiple safety concerns emerged about its planes since a January 5th accident that saw a fuselage panel blow off. Sony has acquired theater chain Alamo Drafthouse, who pioneered the in-movie dining experience. Terms of that deal were not disclosed. The acquisition comes as Hollywood box office revenues and national theater audience struggle to recover from the pandemic. Alamo Drafthouse is North America's 7th largest theater chain, with 35 locations across the U.S. Smaller private credit funds are struggling to fundraise. The latest figures show that the big funds keep getting bigger, as fundraising as a whole last quarter was at its lowest since 2020. That according to Preqin data. I spoke with $31 billion debt manager Arkmon and asked its CEO if that means more consolidation is on its way.
Yes, I think it's inevitable. I think as the asset class has matured and essentially grown up, one thing is absolutely clear, that LPs, investors, want players with size and scale. Investors are looking for scale players. I think also the larger players have managed to do larger deals, which by and large are safer deals. So that's also reflected in better portfolio performance. and you are seeing really a significant number of consolidation events.
Anthony Fobel spoke with me on Bloomberg Brief, which is every weekday at 5 a.m. Eastern. And that is your brief. John.
I watch it religiously, Danny. You know that every morning. Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, the fine line between 1 and 2.
The difference between 2-cut and 1-cut median is 1 member. This is a very fine point to be seeing, pretty big shifts in market pricing.
That conversation up next, live from New York. This is Bloomberg. It's a quieter session, let's put it that way. Equities are just a little firmer by 0.1%. Bond yields are basically unchanged at 431.41. A little bit of price action in the commodity screen. Crude's down 9/10, 77.76. Under surveillance this morning, the fine line between 1 and 2.
The difference between 2-cut and 1-cut median is 1 member. This is a very fine point to be seeing, pretty big shifts in market pricing. I think the broader theme here is this is still a Fed that is looking to cut rates, very supportive to financial markets. I think this is a pretty good setup here for bonds and stocks.
So here's the latest. Treasury's holding steady after a volatile day of trading sparked by cooling inflation and a hawkish Fed tilt. The central bank penciling in just 1/4 point rate cut this year, but investors still favouring 2. Michael Collins of PGIM Fixed Income joins us now for more. Mike, in many ways, the median sort of masks the division, the split on the FOMC. How fine a line is it between 1 and 2 for this year?
Jonathan, it's really a coin toss. I mean, I don't think that's a big deal at all. I think the markets and even the media are making too big of a deal of the difference between one or 2. Remember, before yesterday, the Fed had penciled in basically over the next 3 years, 3 cuts this year, 3 next year, and 3 the following year for a total of 9. Now they've penciled in 1, 4, and 4. For a total of 9, right? They get to the same place in 3 years. I mean, if anything, the potential mispricing in the market is what's ultimately priced in, right? The markets are only pricing in 7 cuts over the next 2 to 3 years, not the 9, and stopping there. And remember, the Fed's long-term dot, even though it's gone up, it's still 2 3/4, right? And the markets are almost 100 basis points above that. So in the near term, again, the difference between 1 or 2, I don't think it's possible to make a lot of money trying to bet one way or for or against that. But over the long term, as Jeff Rosenberg said, bonds are cheap.
Bonds are cheap because you're expecting more easing here, Mike? You're expecting the Fed to deliver what they're signaling?
Over the long term, I don't think they're going to stop at 3 5/8 or 3 3/4. I don't think they're going to stop, after 7 cuts. That's what the markets are telling us they're going to do, right? The markets, John, effectively have priced in a permanence of this higher growth, higher inflation, and higher rate world that we're living in today. The markets are really discounting the possibility that you have, 300 basis points of rate cuts at some point in the next 5 or 10 years. And I'll bet that there's a higher probability that the Fed cuts more aggressively at some point in the future than this really sanguine view the market has.
Mike, let's dig into that a little bit more. Why do you think that is? Because you think that the economy is weakening much more significantly than people expect? Or do you see on the other side that normal looks similar to what it did before the pandemic?
Yeah, I mean, I just think the high growth, look what's happening in Europe and the UK, right? They're cutting rates, and Canada, their growth rate in Europe and the UK, Lisa, since COVID is 0. They have not grown at all. They've just recovered back to where they are. Obviously, the U.S. has been the shining star in the global economic picture. And yeah, maybe that's sustainable. Maybe the AI and the productivity boom associated with that is sustainable. But I do see, a lot of challenges, among consumers, a lot of challenges among small businesses. I think all this wealth creation, and the benefit of higher rates and the benefit of high home prices have really gone to a small portion of the population. And I think the higher these rates, the longer these rates stay high, I think it really does weigh on demand. And you're seeing that, right? You're seeing consumers trade down. You're seeing businesses start to push back on some of their capital investment because of the higher rates. Financial conditions are easy, except for the rate part. The rates are too high, and Powell admitted that yesterday. He admits rates are in really restrictive territory, and he needs to cut them eventually. And I'm just in the camp that, the funds rate is probably going to average, 3 or 3.5, not, 3.5 or 4 over the next 10 years.
So, Mike, right now we're looking down the pike at a 1 p.m. $22 billion auction of 30-year notes. You say bonds are cheap. Are you going to be there, basically shoveling up as much as you can?
Well, we've had a big rally in the near term here. I think it does make a little sense tactically if you could trade rates really tactically like we can to maybe even take profits on this big rally. I mean, rates have rallied 40 basis points really quickly here in 10-year space. And so in the near term, there may be a little bit of a challenge digesting some of these huge auctions. Obviously, the 10-year went great. But again, over the long term, you look where our rates are versus Europe, right? We're still almost 200 basis points above Germany. We're, 350 basis points above Japan. The world, the central banks and the big pension and insurance companies and financial institutions around the world need yield. They need fixed income. And our markets are just stand out to me as being really attractive.
So tactically sell, strategically buy. Just so I'm super, super clear, Mike.
Yeah, I think tactically, we're a hair short in some of our duration in some of our portfolios right now, just on the view that the Fed has historically dragged their feet on taking action, right? That first move is a big one. Powell mentioned that yesterday, right? The first move is a signal, and the markets tend to run with that. And I don't think the Fed wants the markets to get too far ahead of themselves in terms of easing financial conditions even more, right? So I still think there's a decent chance that zero rate cuts comes into play this year. So we're kind of fading, the two that the markets are pricing in a little bit here. But wow, if you're a real, long-term investor like we are, and most of our clients are, Jonathan, and most of the people in the world really are, you're supposed to own more fixed income. It's really in the sweet spot, and there's a lot of value.
I got it. I'd love your thoughts just finally on this. I got this note from BNP Paribas just moments ago. It came from Yelena Shuletseva, former colleague of ours, good friend of this program, who said, November. First move potentially in September, but presidential election uncertainty would argue in favour of waiting until December. November is the month where there seems to be an issue for people, Mike. What do you make of that this Federal Reserve would be thinking about the outcome of November and would rather wait until the back end of this year to see how things work out?
Yeah, I mean, that's part of the problem, right? They're running out of, they have 4 dates left, right? And a lot of people are just discounting July altogether. September is only 6 weeks before the election. And, I really think you need to see the data shift pretty abruptly from where it is today. You need a much more decisive reason to cut rates 6 weeks before the election, just as a because of the potential political blowback. And obviously, November 7th is 2 days after the election. There's a good chance, Jonathan, that we don't know the results of the election at that November Fed meeting, right? Is the Fed going to want to cut rates when the result of the election is hanging in the balance? I don't know. So you're really running out of dates, which is why I think, heck, there's probably an equal chance of zero cuts this year as there are 1 and 2.
True. Mike, thank you, sir. Mike Collin of PGIM, fixed income, plenty to think about. Might not be settled in November. Might have to wait for runoffs. Remember, the Georgia runoffs didn't take place until, early January 21.
Yeah, and we heard about that from Amy Silverman talking about some of the derivatives action. My takeaway from this, and a lot of conversations that we've been having, is that essentially people like bonds once the Fed starts cutting. So basically everyone's treading water before really seeing the sign that they're actually going to make that move. And then can you imagine, let's take a poll of what kind of rally we're going to see. How many basis points of a just absolute plunge do we see in yields pretty much across the curve?
Forgive me for being on the fence, but it really matters what the backdrop is. So is this a mid-cycle adjustment? Or is this like unemployment surging and the rate cutting cycle starts? Because if you listen to what Mike's got to say, and I'll throw in Mike Schumacher of Wells Fargo, they're thinking about the same thing, that when this Fed cuts, it's going to be a cycle. It's going to be deeper than you think it is because they're going to be confronting real economic weakness. That's their call.
And if they don't cut rates this year, the Fed, how much deeper could those cuts be next year, right? I mean, I think that's what a lot of people are trying to crystallize in their minds.
We've got a lot to talk about. We'll do that in the next hour. Joining us is Gargi Chaudhuri of BlackRock, Bloomberg's Craig Trudell. The latest with Tesla with that stock up big time at the pre-market. We'll speak to SocGen's Subadra Rajappa and Jonathan Pingle of UBS from New York. The third hour of Bloomberg Surveillance. Up next.
This is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
Central bankers don't shout mission accomplished.
They are very deliberative right now in terms of not getting too far ahead of themselves until the data comes to them.
The data is probably more important than the dots in this case.
This is still a Fed that is looking to cut rates, very supportive to financial markets. So I think this is a pretty good setup here for bonds and stocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
There's certain things as a broadcaster you enjoy doing. You don't get to do very often anymore. Tiger Woods leading the US Open. I get it. He's played one hole and not everyone's teed off just yet. But he leads the US Open at 1 under. 1 hole played. But, you know, come on, it's Tiger Woods. I can enjoy it just a little bit, just for a moment.
I'll sit there with you. I'll enjoy it. Okay, done.
Scotty Scheffler a little bit later with Xander and Rory teeing off at about 1:14 Eastern time.
Okay, to be completely honest, I don't follow the actual game, but the fact that Rory's getting back with his wife seems like a big deal.
There you go, you see.
Yeah, that I can kind of get into.
Some news you could use this morning.
Big time.
All right, quite a session in the market. You can tell, can't you? From New York City this morning. Good morning, good morning. Equity futures on the S&P 500 positive by 0.1%. Plenty of reaction to the CPI data of yesterday morning and the Fed decision in the afternoon. This from Citi's Andrew Hollenhorst just moments ago. It's about the data. It's not about the dots. So let's talk about the data. Have we learned over the last couple of months that basically the Q1 inflation data was a bit of a head fake, Bramo?
Well, that's really what people are leaning into. Let's just go over what we got yesterday at 8:30 a.m. Eastern. We got the slowest month of core inflation since August 2021. So that really shows progress. On a year-over-year basis, when you look at core CPI, it came in at the lowest level going back to April of 2021. So really, you could see this just grind lower. To your point, a lot of people embracing this as the disinflation that was delayed, not just taken off the table entirely.
So Team September still thinks the door is open, but this is what Team December's got to say. You following? I hope so. This is what Yelena Shulateva's got to say. I mentioned this from BNP Paribas months ago. I think it's worth sharing again. We continue to expect the first cut in December, even though progress on inflation could imply conditions for a first move in September. Here's the key line. Presidential election uncertainty would argue in favour of waiting until December in their view. How important is that this year?
Can I just say how remarkable it is that we are baking in the understanding that this could be, or very likely will be, a contested election that will go on for longer than one day? I mean, that's the base case right now for markets is rather shocking. And yet here we are, and people are trying to understand how to bake that into their assumptions. A lot of people agree with her. Basically, this is a fraught moment. So here's my question. Does this make it actually more likely that the Fed will cut more deeply in 2025? Or does this basically just delay the same rate cutting cycle that the Fed otherwise would engage in? In other words, how much does it weaken the U.S. economy to have the Fed on hold for a longer period of time than maybe the data would warrant?
So I don't have a base case, because I think it's tremendously difficult to establish one for 2025.
That's
what
fair.
I sense from market participants is what they're doing at the moment is pretending it's not happening, extrapolating out current trends, and then they'll think about it once we get to November. Do you have a split government? Do you have a blue wave or a red wave? Do you have conditions that change things markedly in 2025? Super, super hard to forecast, but we have to do the scenario analysis, and we did a few weeks back. Adam Poston of the Peterson Institute making the case that you could see some quite remarkable policy changes on the trade side, on fiscal impulse, that could lead to conditions where this Federal Reserve might have to consider hiking. Now, again, that is super, super contrarian, but that's a view from Adam Poston, and people are thinking about those kind of things. Things could change a lot in 2025.
This is why I actually think it's rather significant that a lot of business leaders, financial leaders, are meeting with Donald Trump today, because there is this feeling in the market that Donald Trump would be sort of the change agent rather than President Biden, considering that he's already been in office for 4 years, and that if he were to come to the fore, he'd be very cognizant of the market's response to any of his proposals. So that would be sort of the gut check on anything that he would do. I'd be curious to see what the tone is with some of these business leaders, because that's ultimately what a lot of people are saying is keeping a lot of those expectations in check. Ultimately, markets will have the final word. That remains to be seen.
You'll hear from the former president a little bit later on today. Equity futures on the S&P. Your scores look like this on the S&P 500, adding some weight to yesterday's all-time high. We're up another 0.1%. In the bond market, yields just about unchanged at 4.31. The euro not doing much, a bit weaker over the last hour, 107.83. Coming up this hour, we'll catch up with BlackRock's Gargi Chaudhuri with stocks at record highs. Bloomberg's Craig Trudell as Tesla shareholders vote on Elon Musk's $56 billion pay package, and Subadra Rajappa of SocGen reacting to PPI and jobless claims data, which drops in about 25 minutes' time. We begin with our top story. Stocks trading at all-time highs after inflation cools and the Fed leaves rate cuts on the table. BlackRock's Gargi Chaudhuri staying constructive on equities, saying this: while the macro picture has been a bit uncertain, the strong earnings we've seen from quality companies keeps us convicted. Gargi's with us around the table. Gargi, good morning.
Hi, good morning.
Not going to ask you about the politics. I'm sure you feel good about that. Not even going to ask you, first of all, about the Federal Reserve. We'll get to that in a moment. Do you think that some of the trends you see that make you constructive on equities are independent of all those things put together?
I think so. I think when we look at earnings for the entirety of the year, you see the companies that have the strongest balance sheets continue to be able to throw off cash flow. And those are the companies that are leading. Not every day. Obviously, yesterday we had a little bit of a small cap bounce. And I think we can continue to see pockets of weaker balance sheet companies having catch up. But if you look at a sustainable period of time, if you look over the next 3 to 6 months, I think quality wins out.
That's leading to market concentration, as you know. Should I be concerned about that? Should our audience be worried about that?
I think that obviously whenever we see gains led by a few companies, we get scared about what that might sort of allude to. But I think broadly, if those companies also tend to be companies that actually are showing profit margin, that they're actually showing a huge amount of cash flow and very low leverage, we think that's a good sign. Now, what we're telling our clients to do is to have quality at the core of their portfolio and then go to a few other areas of the market that have not participated as much, be healthcare, some high quality parts of financials. Even right now, we're kind of thinking about, sort of infrastructure and utilities as other ways to play for the catch-up trade.
Did yesterday change anything for you?
So yesterday was a fun day. I think hearing from Chair Powell, seeing the 1 dot was a little bit of a surprise, given that the data hasn't meaningfully shifted in a hawkish direction since we last heard from them. So to see 3 dots in the April meeting and 1 in the June meeting was very surprising. But did it change anything for me? I think what it did change was a recognition that this is a Fed that's going to remain data dependent, just like they didn't overreact to the stronger inflation data in the beginning of the year. They're not going to overreact to the weaker inflation data. And I think what this means is we have a pretty stable Fed chair at the helm, which I think is a good sign.
A lot of people taking this as bullish. We've heard that consistently from a whole host of different guests, that this basically means risk on. They're going to have your back, essentially a Fed put. If there's weakness, they're going to respond to it, just like what you just said. How much do you lean into the idea that once they start with cutting rates, it will be a cycle, it will be deeper, and it will be something that will ratify what Mike Collins just said, which is bonds are cheap?
Bonds are cheap, especially front end of the bond market, definitely throwing you a lot of really amazing income. So I think investors should take opportunity of that. But I'd also say that when we think about broadly what the Fed is trying to tell us, they're trying to tell us that they're keeping all optionality open and they really want data dependence, whether or not the market believes that. So in 2025, and this is not the base case, but if we begin to see inflation pick up again, will this be a cycle of cutting rate? No, maybe they pause again. They can start this year, they can start as early as September, maybe December, cut rates a few times, and pause again if inflation doesn't allow them. So what I feel very comfortable about is this is a Fed that's going to remain data dependent and not overreact on one side or the other, which, with the strong growth that we're seeing, is actually very good for markets, both bonds and equities.
You mentioned the front end of the yield curve. Can we talk about the complete yield curve?
Yes.
Still deeply inverted, negative 40-something basis points, the 2-year versus the 10-year. Have you got an argument for why people sitting at the front end right now should consider going further out along the curve for less yield? What is that argument at the moment?
So the argument right now is if you're sitting in cash, do step out of cash and sort of start buying some of these very high quality assets in investment grade credit, in CLOs, in even certain pockets of high quality, high yield and treasuries, but keep your duration to about 3 to 5 years. I think that is the argument. Step out of cash, step out of 6 months, go out to the 3 to 5 year. There isn't really a meaningful argument to extend duration further than that, given, to your point, the shape of the yield curve. Now, the argument could be, in another world, that growth is decelerating meaningfully and you need that flight to quality bid for duration. We're not in that world right now. Further, given the pressures on fiscal that we're going to have regardless of the election outcome, I think that brings into question, why don't we have enough term premium in the yield curve? And at some point, if the market begins to price that in, you're better off, again, in that belly of the yield curve.
It kind of is concerning to me that so many people are going to be really reactive to all of the data and the Fed proclamations, not because I think they're wrong. I think that probably that is the way to go. But does that increase the fragility of markets, that there's huge floods of cash that potentially can shift around all at once? That essentially this is a market waiting for a catalyst, and then you will see that just absolute flood of cash that could overwhelm, frankly, markets that look liquid, but a lot of people are arguing are less than under the surface. Does that type of volatility concern you at a time where bond yields already are swinging around quite a bit?
I think that I don't think concern is the right word here. I think it's something that we have to be thoughtful about. I think when you look at the availability of cash, the $6 trillion of cash that's sitting in the sidelines, that's not a risk-off move. That's asset allocation. People are sitting in cash because you're earning 5.375%. It's not what it used to be, where you're sitting in cash because you're worried about some big event that's going to happen. So I do think we have to think about that as asset allocation and then think about, okay, what are some risk events that might need to get out of the way before people feel good about investing? One is certainly the Fed. What we hear from clients is people love fixed income, waiting to invest, but waiting for Fed to get out of the way. Well, when and if that happens, there's going to be that cash, but I think that's worthy. That makes sense. Similarly, election is a concern. And obviously, we can see some volatility going into October. I think once we're done with that event risk, whenever that happens, we can see investors moving out of cash. Again, we think to high quality equities.
I'm so pleased you said that. There's a massive difference between T-bills and chill and T-bills and tin hats. Like, this is T-bills and chills. It might be T-bills and tin hats later on this year. I've got no idea, but that's not where we are at the moment.
I love it. It's an asset allocation choice, and it doesn't look like a terrible choice when it's 5.5%. And you just get fund manager after fund manager trying to argue against that, but saying like
reinvestment risk.
I kind of get it, though.
Reinvestment risk.
It's getting harder to make that argument.
And then every time the Fed meets, they just sort of drop the dots a little bit more and push out the rate cut call. It's getting difficult to convince people.
Yeah, although I wonder what happens when that flood of cash happens. I mean, again, how much could yields possibly go down? Are we looking at a 0.5 percentage point decline in one day? I mean, just think about who's going to even let go of their bonds to sell them at that moment, given the sort of rush into fixed income.
So here's the important piece of that. So it's T-bills and chill now, right? Because you get yield. T-bills and tin hats is a very, very different story. You could accept even less yield at the front end of the yield curve and still be in cash because you're worried about what's happening elsewhere.
Yeah.
That's why it's a really difficult call to make. A rate's coming down because things are scary. A rate's coming down because we've got disinflation, that immaculate disinflation story. Then that cash gets distributed elsewhere. It's a very different story.
Notice that no one's going to really try to work that out. They're just sort of saying,
in
the next 6 months, this is what's working. And it makes sense. I get it.
You just sort of extrapolate out where we've been in the last 5 minutes.
I mean, what else can you do?
6 to 12 months. I mean, that's kind of it. Equity futures right now recovering as Bramo speaks, which is rare. Equity futures positive by 0.2%. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. G7 leaders have agreed on a plan to tap frozen Russian assets to provide Ukraine with $50 billion of fresh aid. That, according to people familiar. After months of discussion, the plan is set to win the backing of leaders at the summit in Italy this week. The structure of the loans would reportedly be based on the size of individual economies. The nations would then give loans to Ukraine and would be repaid using the profits generated by the roughly $280 billion of blocked funds, most of which are immobilized in Europe. Apple isn't paying OpenAI to use its chatbot. Apple believes that promoting ChatGPT to its users is of equal or greater value than monetary payments, according to people familiar. The iPhone maker revealed a partnership with OpenAI during its Worldwide Developers Conference this week. At the time, they said ChatGPT will be offered for free on Apple's products. Apple's deal with OpenAI isn't exclusive, and the company is already discussing offering Google's Gemini chatbot as an additional option. Manhattan rents slipped for the month of May. According to data from Miller Samuel and Douglas Elliman Real Estate, rents were down 3 1/3% year over year. The median rent coming in at $4,250 per month. New leases, though, were up 41% from a year earlier, but helping to keep prices down, inventories also climbed about 28%. And that's your Bloomberg Brief. John.
Danny, thank you. 42.50 is still just ridiculous. I know we said that already this morning, but 42.50 median rent in Manhattan.
Yes. Well, I mean, honestly, this is what you're looking at. The fact that that's actually a step down from what it's been gives you a sense of just how far we've come.
Yeah, and as we said earlier, that's kind of the division right now between policymakers at the Federal Reserve. In the White House, so we're talking about inflation stabilizing and coming down, things are getting better, and everyone's looking around and saying, yeah, it's still expensive. Yeah. Still 42.50.
Well, that's the thing. I mean, when people strip out healthcare costs, they strip out home improvement, and they strip out what you pay at the grocery store, and they strip out what you pay for your kids' education. Right. It's like, everything else you're doing great.
Up next on this program, the morning calls and Bloomberg's Craig Trudell on Tesla CEO Elon Musk's record pay package, and a special thanks to Gargi, because Gargi, I don't think I squeezed that in. It's good to see you. Thank you. Tesla up by 6.5%. You're opening about 1 hour and 15 minutes away. The opening bell, 1 hour and 12 minutes away. Equity futures positive by 0.2%, looking to add some weight to that record-breaking rally over the last 3 days or so. Let's get you some morning calls. First up, Deutsche Bank resuming coverage of Nike with a buy rating and 115 price target. The analyst saying the company is ramping up innovation ahead of the Paris Olympics and can gain back shelf space. That stock is just about unchanged in the pre-market. Next up, Barclays boosting its price target on Broadcom to 2K. The analyst keeping an overweight rating, saying it remains one of the best ways to play AI. That stock is up 14% in the pre-market. And finally, Wedbush maintaining an outperform rating and 275 price target on Tesla. Analyst Dan Ives saying the shareholder approval of Elon Musk's pay package and move to Texas removes a $20 to $25 overhang on the stock. We're positive in the pre-market by 6.5%. Joining us on that story is Bloomberg's Craig Trudell. Craig, big day for the likes of Elon Musk and Tesla shareholders. What are we likely to hear a little bit later?
Yeah, based on a late night Musk X post, we're going to get good news on the fronts that you just referred to. The most important one really for shareholders has to do specifically with Musk's pay package, which was arranged in 2018. He hit all of these, sort of moonshot achievements that, the payout was incumbent upon him, hitting those goals in order to get the stock options lined up for him. The issue, of course, was that in January, this got thrown out by a judge in Delaware. And so this is an effort to kind of bolster the case for undoing that ruling or challenging it in the courts. It does not mean that, after today, Musk, goes home from this meeting with his stock options. But it is, a shot in the arm for him and potentially for the board as they, fight this and take that fight to Delaware.
Dan Ives mentioned that overhang on the stock. He said it's been a $20 to $25 overhang on the name. Lisa asked this question earlier this morning, Craig, and I think it's the important one to ask. This feels like this morning, as you were, if the votes go his way. What would have changed if he'd lost this vote?
Yeah, I mean, I don't know how you possibly put a price or a dollar amount to just how much this was keeping the stock down. And I think some other analysts who have opined on this really sort of describe it more so as avoiding what would have been a really dramatic drop had the vote gone the other way. And that makes more sense to me, right? Because Musk, if he leaves the picture, this is not, remotely a stock worth as much as it is now. I think the fundamentals of the company, absolutely, have been going in the wrong direction. And that has also gotten lost in all of this attention on whether or not Musk is going to stay or go, and his sort of threats to, take AI elsewhere unless he gets 25% control of the company.
Craig, the market's trying to quantify how much the chance of him not getting that $56 billion bonus was. It's about 6.6%. That's at least where we are pre-market in the stock trading for Tesla shares. I am curious, though, to that point of where his focus is. How much does this mean that Elon Musk is going to take the chips from X or some of the other companies and try to find a spot for them in the actual Tesla vehicles, which is essentially the great hope of a lot of these bets in this company?
Yeah, I think it's interesting. Tesla IR spent some time recently with JP Morgan, which just put out a report yesterday, trying to address some of these very questions of just, what to make of those threats. And there was an attempt on the part of Tesla IR to kind of separate, XAI, the company that is closely tied to X, is working on, stuff more so like chatbots, whereas with Tesla, this is, quote unquote, real world AI of trying to get, cars that are out on the road to a point where they're able to drive themselves, and really trying to kind of, separate those two. But the fact that he's, devoting time and attention to standing up yet another company over the last, year or so, after already, kind of taking his eye off the ball and acquiring Twitter, and, the effect that had on the company and the stock, this is precisely, what leads to some shareholders saying, this pay package didn't work. It didn't ensure that we had his attention. And that was already an issue before he went out and bought Twitter and built up XAI. But it's only been exacerbated as a result of those moves.
Craig, a lot of people might argue it's sort of a distraction that Elon Musk is here fighting whether he can still get his $56 billion pay package. I'm a little surprised he's not in Puglia, in Italy, talking to some of the leaders down there who are talking about potentially putting tariffs on his vehicles that are made in China. At what point does he need to get on a plane and get over there to try to figure out how to get a couple carve-outs to make sure that he's not penalized in tandem with some of the Chinese auto manufacturers?
Well, there's good news on that front in that Tesla was the lone manufacturer called out yesterday when the European Commission announced those tariffs as potentially, being able to be assigned a different tariff rate than other companies. And, it required quite a bit of paperwork, we're told, to try and, make the case to the Commission that they were, that they received less state support than some of these other companies. And, the way in which the Commission arrived at these rates was based on the level of subsidization. So they need to make the case to the EU that, hey, we haven't made, as much off of subsidies as, say, a BYD or an SAIC or a Geely, and therefore don't hit us with this, 21% rate that will come into play around July 4th. We should be subject to something lower than that, but that would not be relief that they would feel until later this year, around November.
Craig, just quickly, what did you make in the difference of approach from the Commission versus, say, the government here in Washington?
Definitely more surgical and based on more of a process. I don't necessarily get the sense that the tariff rate that the Biden administration has put on Chinese EVs, was a sort of scientific, calculation. It was essentially, let's take this as high as we can possibly go.
That's what it felt like. Craig, thank you, sir. Craig Trudell of Bloomberg in London. Surgical in Europe, sort of laborious process, as you might expect down to the Europeans. Lots of bureaucracy and paperwork. Got to apply for this, apply for that. And in America, just big hammer, just saying, nope, 100%.
Right. Basically, the U.S. saying, we don't want your electric vehicles. And Europe saying, kind of, maybe we do, but I don't know. We just want to make sure that our companies can deal with it. And, we'll work with you and let's take a look at what oversupply really means.
It's kind of bizarre when the headlines were coming out the last couple of days. Tesla, by the way, in the pre-market, as Lisa mentioned, up by 6.8%. Coming up next, PPI data and another round of jobless claims. The reaction from SocGen, Subadra, Rajappa and UBS's John Pingle. Looking forward to their reaction. And a little bit later, we'll catch up with Anne-Marie on what you can expect out of the G7 in Italy a little bit later on today. Seconds away from some economic data in America, 1 hour away from the opening bout. The scores look like this going into PPI and jobless claims. Equities on the S&P 500 positive by 0.25%. A lift on the Nasdaq, up by 0.75% on the Nasdaq 100. For a single mover, Tesla doing nicely in the pre-market, as it looks like the vote is going Elon Musk's way ahead of that meeting today. In the bond market, yields on a 2-year at the front end of the curve, aggressively lower yesterday, down again today by 2 basis points, 4.72. With some economic data, here's Mike McKee. Good morning, Mike.
Good morning. Well, for those thinking maybe just one cut this year, don't know. Initial jobless claims come in much higher. 242,000 after 229,000 last week. Unrevised. We'll check the revision on that. Continuing claims at 1,820,000. Those are up significantly from the 179.2 that we saw the week before. Now, PPI comes in down 0.2 on the month, and the core comes in flat, as does ex-food and energy trade. The extra core we get with PPI also flat, so that leaves us at 2.2%, same as last month for the final demand headline year over year. Now remember, PPI went up significantly last month, 0.5% during the month, so holding at 2.2 is good. 2.3 for core, down from 2.4, and 3.2 for the ex-food, energy, and trade. That's up from 3.1, so we get a little bit of, I guess, a base effect there. But what we're looking at is jobless claims going up, the labor market maybe weakening a little bit, and PPI going down, inflation going down. I think, the obvious first question to your people around the table here is, are you going to change your Fed call again from yesterday? Since now things are meeting Jay Powell's criteria.
What I'd love to know, Mike, is if the FOMC had this data together with yesterday's data, how those forecasts might change. This data just a little bit more freezing cold water to throw over the dot plot we got just yesterday. Check out the price action. Equities positive off the back of this on the S&P 500, on the Nasdaq, on the small caps as well. We're up by 0.4% on the S&P, up by 0.9 on the Nasdaq. In the bond market, quite a move at the front end of the curve this time yesterday, following that downside surprise on CPI. Down another 7 basis points now, 467.80 on 2s. Call it 468 on a 10-year, back in the 420s, 425.58. Put it all together, Lisa. Downside surprise on CPI. Downside surprise on PPI, wrong kind of upside surprise on jobless claims, and the tone of that data, together with the tone of the outlook from the Federal Reserve, is even more difficult to reconcile.
It seems like the Fed certainly being more cautious than anything else at a time where the data certainly does seem to be shifting. If we do want to play narrative table tennis, as you put it, as others, James Athey put it, this is additional confirmation that the disinflationary trend is underway, and that the core PCE will, if you just grind it through the sort of data grinder, will come out lower, and that will give the Fed a chance to potentially cut. This, though, is the messiness of this. When you strip out food, when you strip out energy, when you strip out trade, the inflation actually creeped up on a year-over-year basis. So there are some real questions under the hood. That said, definitely some positive progress.
Mike McKee is going to stay around the table with us. Let's introduce Subadra Rajappa of SocGen alongside Jonathan Pingle of UBS. So we have team no cuts in 24 alongside team December now, because we had a change over at UBS just yesterday. I want to come to SocGen first. Subadra, let's talk about this data. What does this data tell you? And put it together with what you heard from the Federal Reserve Chairman yesterday and sort of square that circle for us.
This is, of course, one data point. The fact that the claims number went up is something to keep an eye on, because typically when you tend to see a deterioration in the employment picture, you tend to see that led by initial jobless claims. It tends to be a leading indicator. But that said, again, one data point doesn't make a trend. We'll be looking to see what happens. What was interesting to me
in yesterday's summary of economic projections is the fact that the Fed kept core PCE at 2.8% for this year. So they're expecting about roughly 0.2 increases month over month for the remainder of the year in core PCE. So in that sort of context where inflation is still relatively sticky and the job market is quite strong and growth is in the context of 2 to 2.5%, I don't see any need for the Fed to rush in to cut rates.
I want to couple your inflation outlook with their outlook for unemployment. They see it staying exactly where it is right now, 4%, year-end 2024. Jonathan, how are you thinking about the incoming information stacked up against what they're projecting for the rest of this year?
Well, that was actually a big reason we went from Team September to Team December. I mean, we were actually forecasting an increase in initial jobless claims today to 235. We were expecting an increase in continuing claims, and we were expecting a downside surprise on PPI, and we were actually one of the few shops expecting a 0.2 on core CPI yesterday. We have been watching the data slow and think there's a slowdown underway, but we got an FOMC that really just seems to think growth's fine, and not just fine, but great. I mean, they didn't even mark down their assessments of the pace of the expansion in the first paragraph of their statement, which is typically where an FOMC would acknowledge some moderation. But they seem extremely comfortable with the current stance of policy. They feel like, the labor market is still healthy. I mean, I will agree that is one place where if it does roll over rather quickly, they might respond. But it really looked to us like an FOMC that seems very comfortable waiting and without a lot of urgency to start dialing back restrictiveness.
Subadra is sitting here thinking, all right, everybody just keep coming to my way, because I've been saying this for quite a while, or no cuts at all this year. Are we asking the wrong question? Are we basically asking when are they going to start the rate cutting cycle and not what the rate cutting cycle is going to look like if they wait longer? In other words, if they do not cut this year, Subadra, are they going to have to cut much more deeply next year in the face of that weakness that Jonathan was talking about and a lot of people are projecting?
I think I would prefer that than being in the situation that the ECB is in, where they've said they cut rates, and then now it's uncertain if they're going to cut in July. It doesn't look likely that they'll cut they might cut in September. But then after that, they're looking at unit labor costs going up. They're looking at other factors that's going to keep them on hold. I don't see the need for the Fed to cut. I don't see the need for any sort of insurance cuts. Why should they cut and then wait for 6 months to deliver the next cut? Why not just wait for the data to corroborate a need for cuts and then go on some sort of a methodical fashion, or maybe once a meeting or once a quarter when, to ease policy? I just don't see kind of the rush for that first rate cut.
Jonathan, would you agree with that? Are you sympathetic to the view that some have espoused, including Neil Dutta over at Renmac, talking about how this is a rapidly weakening economy, and if the Fed doesn't get ahead of it, that the declines are going to be harder to counter in the future?
I mean, if I were a monetary policymaker, I would probably thinking about some calibration might be needed to ward off worst case outcomes. I think one of the problems is that we're seeing slowing in growth, but we're not really seeing such severe slowing that monetary policymakers seem like they really need to act urgently. But, we have that. That's our expectation, is that growth is going to slow. It's going to take the FOMC time to digest. But next year, they're probably going to want to pick up the pace a little bit, right? I mean, so we have them, after they see payroll slow, after they see GDP growth slow, we've got a little bit lower inflation forecast than they do, that they're going to start to feel like, look, maybe policy really is restrictive, something they've been debating a little bit. Maybe we need to get out of this restrictive stance of policy a little bit more quickly than we expect. So we expect them to have the same terminal rate that they have in the S&P, but get there a lot faster next year and into 2026 than their current projections.
John, I don't want this to turn into a therapy session for Wall Street, but I just imagine it must be incredibly frustrating for you to have absolutely nailed the data of the last 24 hours and then been surprised with the way they've responded to it. What are you struggling with right now? Their reaction function, or just the way they're seeing the data that you've been forecasting? What is it?
I've been a little surprised at their sort of lack of acknowledgement over the degree of cooling, I think, that's underway. I mean, non-farm payroll employment looks good, is certainly a headline, and they've sort of walked away with that as sort of a summary statistic for the strength. But even if we look at non-farm payroll employment, I mean, Private employment over the last 12 months has slowed to sort of 178.
Can I jump in? You say they walk away with that. And I walked away from the news conference yesterday and I heard Chairman Powell say something like maybe 272 overstates the strength of the labour market. I just wonder who they is on the committee right now. I find it really confusing. 272 for some seems like it's the real deal, hence the dot plot. It's another part of the dot plot that feels like they're in Camp Powell. Maybe it overstates strength. When you say things like they, who are we even talking about in the committee anymore?
I would actually, in terms of this narrative, I'd lump in the vast majority of participants. I think when I hear Governor Waller talk about the strength, think about Philip Jefferson's speech before the quiet period, talking about the strength in private domestic final purchases. I mean, they're all pulling out relatively strong components and cuts of the data at the moment, and I feel like you got an element of that in Chair Powell. Even though he might acknowledge that the 272 was overstating, he's not acting as though it's 190.
Mike, what was your take?
I think that at this point, they don't know what they're doing. And so they're going to be honest about that. The difference between Subadra and John is that you guys have a forecast, and you make a forecast, and they have 19 forecasts. And we, for our convenience, pick out a median and say that's their forecast. It's not their forecast. There's 19 different forecasts, and the range is pretty wide, and especially if you look at 2025. The range is very wide. There's a plurality in the middle, but they don't know what's going to be happening by then. So, and another quarter from now, in September, they'll change their forecasts and their dot plot again, and we'll all recalibrate. I think basically they're in a sort of hold mode, risk management mode, I guess, at this point. We'll see where inflation goes, and we can move, but we don't have to.
You know, John, you didn't want a therapy session. I think that actually
We're
right
about
now,
to get one.
A lot of people are looking for a therapy session because it was a lot of uncertainty, and it's been a very challenging year. So, Subadra, I'm curious how you come up with a projection of there is enough strength. We don't need those sort of cuts to sort of be cosmetic or get ahead of that weakness. What gives you conviction in that? What's your guiding compass at a time of such great uncertainty?
You can listen to the Fed. For instance, when you listen to John Williams from the New York Fed president, what he said was his expectation is for growth in the context of 2 to 2.5%. He's expecting the unemployment rate to be around 4%. And he's expecting core PCE above or at or above 2.5%. So even from what they're saying, just from their own forecast and the summary of economic projections, leave alone our forecasts and our expectations, there's no clear indication that they're going to need to rush into cuts. That's why I think that, in addition to our own forecast from our economists, what we're hearing from the Fed is also consistent with the Fed that needs to be on hold for the remainder of the year.
Honestly, I got to say, John, one thing that people, Jonathan Pingle, one thing that people keep saying is all of this out there, it sounds bad, it's hard to gauge, whatever, but, NVIDIA is going to change the world. We're going to have all these technological advancements. We're going to have fiscal impulses that come down the pike. How do you factor in sort of the nebulous concepts that have driven this market this year, as opposed to sort of overarching macro top-down views?
So we could get an NVIDIA boost. I would say if that really was a productivity boost, we would see lower inflation, and the Fed should probably have lower rates as well. And the fiscal policy obviously has been huge. I mean, it's really done a lot to insulate the economy from the rate hikes and the rapid rate hiking cycle of Fed. And that is an impulse that's fading right now, and we're going to head into 2025 with a year Congress is probably going to spend having to rewrite a substantial amount of the tax code to avoid the fiscal drag at the end of the year. So these are all meaningful influences. I mean, we all just have to sort of do our best, look at the details, aggregate up. But I mean, I would sort of echo this point. It's not necessarily that we can debate how we're thinking about our growth forecast, but if we take the wide swath of FOMC participants, they just don't seem to be internalizing any trade-off between growth and the level of interest rates right now. And that just seems to be a group that is willing to wait. And the other reason we pushed out our call is just, when they get into September, if they're still not facing a trade-off with weaker growth, I think the arguments will carry the day to wait longer.
I have to wonder, Subadra, August 22nd, August 23rd, I think it's August 23rd that Jay Powell is going to be in the Tetons, and he's going to be talking to people, giving a message. At one point, it was a very clear message. Pain. It's all going to be pain. We need to get this under control. What's it going to be this year?
I think it's staying the course. I think it's caution. For the most part, the Fed is going to strike a cautious tone. In my view, at least, I felt like they pivoted too soon towards rate cuts late last year. And I think that they're going to take a much more cautious tone and wait for the data to guide them on policy. So our expectation is that they'll start cutting sometime in the first quarter of next year, and then deliver a steady set of cuts for the remainder of the year. But then the terminal Fed funds rate is probably going to be higher. We think that the R-star is also higher. And you're seeing that in the market pricing for both the Fed as well as for the 10-year yield, which is higher for longer. So the market is ever so slowly calibrating to a much higher R-star. And so I think that the Fed is going to be somewhat cautious. This feels like a little bit of a paradigm shift, if you will, from the period after the great financial crisis when we were bringing down the R-star ever so gradually. Now we're going to go the other way and start recalibrating R-star higher.
Just perfectly said. It feels like post-GFC in reverse at the moment, that's for sure. A special thanks to Team 2025 and Team December, Subadra Rajappa and Jonathan Pingle. Thank you. Just want to summarise some of the data we got about 15 minutes ago. Mike McKee, what's your take on things? PPI, jobless claims.
PPI also surprises the same way that CPI did yesterday, comes in much lower, although it's mostly goods, and within that category, it's mostly energy. So there are a lot of declines in prices at the factory gate, but it is the big surprise came from how bad energy fell. Jobless claims, a surprise because they haven't been going up. Now they did. We'll see if this is more of a one-off, but if it starts a trend or we get into a new trend level, then the Fed has something to talk about.
We've had a few more head fakes on that particular print, jobless claims, over the last few months. So we'll see if this one is a head fake or not. This from Renaissance Macro just moments ago. The growth and inflation trade-offs for the Fed are shifting. It's getting close to time to recalibrate policy. I imagine we'll hear that a few times a little bit later today.
Neil, I hear you pounding the table. I hear it loud.
Yeah,
I get it. You're like, let's go, let's go, let's go. It's interesting, you know, I'm curious why people are not on that page. And why he is on that page, considering that it's sort of unclear at this point.
I didn't hear Neil Data in that news conference yesterday.
No.
At all, that's for sure. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla will likely raise prices for its flagship model, the Model 3, in European markets. That follows the announcement that the EU could impose tariffs on imports of EVs from China, even from Western automakers. Tesla manufacturing does have a large presence in China. The automaker delivered over 900,000 vehicles from its Shanghai factory last year. Tesla said the price increases will likely go into effect on July 1st, and the tariffs would go into effect just a few days later. Donald Trump is back in Washington, D.C. today. The former president is meeting with some leaders of the country's biggest companies, including Jamie Dimon, Jane Fraser, and Tim Cook, according to people familiar with the event. During his one-day return to the Capitol, Trump is also set to meet with congressional Republicans. And Florida is in a state of emergency. Heavy downpours flooded Miami streets and grounded hundreds of flights at the Fort Lauderdale International Airport yesterday. The state has already seen a record amount of rain for the month of June, and more is expected today. Officials projecting that damages will top $1 billion before the rain stops. That's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the programme, setting you up for the day ahead and going into the weekend. We'll catch up with Anne-Marie from a beautiful Italy. From New York, this is Bloomberg. Counting it down to the opening bell, about 14 minutes away. The S&P 500 positive by 0.2%. Equity futures with a bit of a lift. Bond market rally, again, we're down by 5 basis points, 4.2655 on a US 10-year. PPI coming in a little bit softer than expected. That's the right kind of downside surprise. This is the wrong kind of upside surprise on jobless claims. Claims come in at 242. The estimate was 225. We've had some head fakes in the past with this read over the last 6 months or so. Let's see if this is another one, but that would be concerning if it continues. 242 on jobless claims. Here's your trading diary for today and tomorrow. President Biden meeting with Ukrainian President Zelensky at the G7. Former President Donald Trump in Washington meeting with lawmakers and CEOs. Treasury Secretary Janet Yellen speaking with Fed President John Williams at the Economic Club of New York. Tomorrow, UMich Consumer Sentiment Survey data and a BOJ rate decision to wrap up a busy week and get you to the weekend. Joining us now before that weekend is AMH at the G7 meeting in the south of Italy. Anne-Marie, set us up for the next 12 hours or so. What are you expecting to hear?
Well, what's really important is going to be Biden's press conference alongside Volodymyr Zelensky. President Biden is really going to want to tout the fact that the Biden administration was able to get over the finish line, really what has been their brainchild for the past few months. And this was the idea of tapping into future appreciation, that net interest that these foreign and frozen and mobilized Russian assets can potentially accrue. So this is a big win for the Biden administration. He's also going to sign up with Zelensky a bilateral security pact. Of course, we also want to keep an ear out for what potentially Larry Fink and Satya Nadella may say. These are two executives that are coming here to Puglia at a side event co-hosted by Biden and the Italian Prime Minister Giorgia Meloni. They're not going to mention China by name. I highly doubt it. But this is about critical infrastructure in lower and middle income countries. And I think really what this is going to be about is basically saying sign up for what the West wants to do, not potentially what China wants to do. And then, John, a little bit more lighthearted. Potentially the fanfare, though, won't be light. I'm interested to see, although Biden is skipping tonight's dinner with G7 leaders, I'm interested to see what Meloni decides to put on the menu, but he will be at tomorrow's G7 leaders dinner.
Talking about Giorgia Meloni and how she's really leading this, how much has the tone changed from prior G7s, just simply because she is representing a sort of different swing in the voter base based on where the existing politicians, where they have been representing?
I think a question coming into this after the European parliamentary elections and after the polling we've seen in countries like the United Kingdom that's going to have an election in 3 weeks, and the polling we've seen in France and in Germany, and the fact that AfD lawmakers literally did not show up to President Zelensky's address to the Bundestag. What you can potentially ask going into this is Europe moving to the right towards Meloni, or is Meloni moving towards them? And I think what you see is that Europe is definitely moving more towards Meloni. As John said earlier this week, this G7 is Meloni's G7 in so many ways, because you have a number of leaders coming here as lame ducks that do not have the backing at the moment of their electorate, and potentially, in as soon as 3 weeks, may be out of a job.
There's a great headline on Politico today. 6 lame ducks and Giorgia Meloni meet the G7 class of 2024. Rings true. Anne-Marie, let's have some fun. Let's talk about the menu. I was at a Macron event a couple of months ago, and there was no food. There was no food at all. There was just black coffee. Can you tell us what you think is going to be on the menu later? And can you tell us how they're feeding the journalists on the ground in the south of Italy?
Well, if they're feeding the journalists at any caliber is what they're going to feed the leaders, then the menu is going to be absolutely spectacular. Even for the journalists, someone like me, as I would say, sono celiaca, I have celiac, I don't eat gluten. They had 2 tables set up with pasta, cookies, cornettos, the croissants in Italian, that are gluten-free. So the food has been unbelievable. I'm interested also in the wine list. I don't know, John, do you think they're going to go Negro Amaro? Are they going to go Susu Mignello, Primitivo? We'll have to see. But I will say this, the Italians are definitely showing up on the hospitality front better than any G7 I have attended.
If you're confused, this is not Bloomberg TV. This is the tourism board for the south of Italy. AMH from the G7. Anne-Marie, thank you. We're not jealous at all.
I'm on strike for the rest of the show. That's it. Until you send me there, I'm not speaking.
Such an Italian thing to do. Isn't it amazing?
I know, it's ridiculous.
Just like, lay it all out.
And it's, of course, softball basically pitch for southern Italy.
For
basically
the fatherland.
Imagining where you could be and how it could be, and just drawing the contrast with France, really. You're going to get hate mail from the French. Oh, yeah, it's striking. There was no food with Emmanuel Macron.
Just black coffee. They can sort it out next time.
Paris.
They'll learn from that.
Yeah, exactly.
Foreign journalists come in. What do they walk away with? They remember what they were fed.
Didn't Alitalia used to have the most amazing food?
They still do. Erita now. Fantastic menu.
Didn't they go bankrupt?
They did, and that's why. Probably. I'm not saying that's why.
Fantastic.
We need to talk about this market. CPI, softer than expected. PPI downside surprise, jobless claims in the wrong direction. Square that with what we heard in that news conference and what we saw in those forecasts from this Federal Reserve.
Andrew Hollenhorst does it by saying, follow the data, not the dots. I really like that idea. Of course, he is still calling for a significant weakening and a significant rate cutting cycle to begin this year. How you interpret the data, up to you. Have fun. But the dots not giving that guidance.
We'll follow that data, and we keep following that data. We'll follow that data into tomorrow. Coming up tomorrow, Jeff Yu of BNY Mellon will catch up with Pooja Sriram of Barclays, Morgan Stanley's Michael Zezas, and PG&E CEO Patty Pope. Looking forward to all of that. Your equity market is positive by 0.3% on the S&P. Your opening bell is about 35 minutes away, and the bond market rally, Bramo, it continues. Yields down 5 basis points.
Shot, chaser, and then another shot with the PPI coming in softer than expected. In the labor market, are we seeing a real softening?
Just need you, Mitch, to come in, going into the weekend, and then the trip's complete.
Oh, is that it? Is that the
you, Mitch, is super important.
It is super important.
You
forward year.
You take that phone call and tell them how you feel.
Oh, I will. I'll answer online.